Good morning. Andy, can we have a roll call, please? Governor Lujan Grisham. Commissioner Garcia Richards. Here. Treasurer Eichenberg. Here. Secretary Romero. Secretary Romero. Mr. Lavender. Mr. Rawson.
Pass. I'm here.
Mr. Messina. Mr. Tejas. Ms. Allen.
Yes, here.
Mr. Bingaman. Mr. Bingaman.
Present.
Thank you.
So it sounds like we do not have a quorum. That's 5 minutes.
A few dialed in. Secretary Romero, are you on the call? She said she was going to be. Mr. Lavender.
He is calling in. He will call in just a minute.
What about Jennings?
Okay, let me get back. Secretary Romero. Mr. Jennings. Mr. Lavender.
I'm here. I'm here.
All right. Great.
Mr. Messina. Sorry, Mr. Messina.
Actually, Andy, let's move on with our agenda since we have a quorum.
Okay, great.
All right. So I'm going to go to a motion to approve today's agenda.
So Mrs. Harold, move. Or second.
All right. I've got a motion by Member Bingaman, a second by Member Lavender. And we're going to take a roll call vote on the approval to on the motion to approve the agenda.
Commissioner Garcia Richards.
Yes.
Treasurer Eichenberg.
Yes.
Mr. Lavender.
Yes.
Mr. Rawson.
Yes.
Ms. Allen.
Yes.
Mr. Bingaman.
Yes.
The agenda passes. The motion passes. Madam Chair.
Okay. Can I have a motion for the approval of our November minutes?
This is Harold. So move.
I second. This is Kathy. All right. We've got a motion by Member Lavender, a second by Member Allen. If we can have a roll call vote on the approval of November SIC minutes.
Commissioner Garcia Richards.
Yes.
Treasurer Eichenberg.
Yes.
Mr. Lavender.
Yes.
Mr. Rawson.
Yes.
Ms. Allen.
Yes.
Mr. Bingaman.
Yes.
All in favor of approving the minutes, Madam Chair.
All right, great. Thank you so much. So we've got a pretty large agenda ahead of us today. 9 voting items that I can see. So to give us time to dig into those things, if others could keep their remarks fairly brief, I would appreciate it. We're going to start off with the Sio Briefing.
Thank you, Commissioner, and good morning to each of you. I refer you to the State Investment Officer's briefing for January, which is in your materials. As we do traditionally, I will report on December 2021 total distributions over the last 12 months. $1,112,611,506. December 21 total contribution from the State Land Office. Everybody, please listen to this one. $138,604,000. That's an increase of $17,263,000 from November. So for year-to-year comparison purposes, the December 20 contribution for the State Land Office was $767,000. Thank you, Commissioner. Thank you to those who provide those funds. Net asset value as of Friday was $35,509,000,000. New Mexico West Texas Intermediate pricing as of Friday was at $81.69 per barrel, up from $49.89 per barrel a year ago. Our New Mexico rig count, 95 as of Friday, up from 65 a year ago. Natural gas pricing, U.S. $3.96 per MCF, up from $2.49 a year ago, and it continues to be really tough to try to access current New Mexico natural gas pricing. When we figure out how to do that, we'll give you those numbers too. Moving on to item number B on the briefing, please notice under net asset value detail, the 12/31 numbers from 2010 to 2021, showing an 11-year growth of $22 billion in assets. Please note that our clients, as the end of last year, totaled 23, and they have $1.8 billion invested with us. Moving on quickly to council matters. You will see the dates and the times of the upcoming February meetings. I want to restate for everyone on the call some really important things that appeared in last Friday's weekly publication, which Charlie puts out. Year-end 2021 numbers. The severance tax fund, fiscal 23 distribution, $265,791,000, which is up $19.4 million year over year. And of course, these distribution numbers are what it's all about. Land grant FY23 distribution, $1,014,000,000, and that's a distribution growth of $106 million year over year. So when you combine those two, you see a growth of $5 billion in calendar 2021. And that doesn't include the tax stabilization reserve, the early childhood fund, the tobacco fund, the water fund, or clients. When you put those into the equation, our combined distribution, $1.28 billion, that's up $125 million year over year. We talked about the land office contribution. This year's inflows blew past the last 2 years' inflows substantially, as you noted from the numbers I gave you. Here's another important factoid, and then I'll be quiet, and I think we had a question. 2023 benefits to New Mexico taxpayers will be the equivalent to tax savings of $1,630 per household. Was there a question? Okay, if not, I'll move
Yeah,
on.
we can take council questions. Oh, okay. You're not finished.
No, just a little bit more, Commissioner, if I may. Going to operations, recruiting and retaining staff. This is a problem. I won't list those that we are recruiting. I will say, and I emphasize this strongly, our losses of key staff, the ability to recruit qualified staff, are impeded by our inability to offer peer competitive compensation. If this isn't resolved soon, your staff's ability to properly invest and steward the funds is in danger of being seriously compromised. So I'm sorry to have to add that alert, that negative comment to the other very good news we just had. Happy to discuss that with any of you if you want to give me a call. We are also working to make council meeting materials more user-friendly. I think you've all experienced the lack of friendliness in going through the materials for today, as the commissioner just mentioned. Under external relations, Charlie and I are trying to craft an effective public awareness effort so that more people in New Mexico understand the value of the permanent funds. With respect to the House Appropriations and Finance Committee budget hearing recently, our appropriation request for FY23, we asked the committee to approve the slightly higher LFC recommendation for next year to address these serious recruitment and retention matters I just mentioned. And the committee agreed to the higher request of $64.5 million, saying that some flexibility needs to be allowed to to enable us to address these concerns, and we so appreciate that. Charlie, do you want to add anything on legislation or clients?
Thank you, Steve. Members of the council. As of this morning, there's about 350 bills that legislators are working on. There's about a dozen of those that we are tracking. Initial hearings are underway, including one this morning that would authorize a $50 million appropriation to the Water Trust Fund. There's a similar bill in the House. Other notable bills, House Bill 104 will create a venture capital fund to invest in New Mexico venture firms or make direct investments in New Mexico companies. The fund to be created here would be from general fund dollars managed by the MFA, not by us. Similarly, there's some bills that would fund the Research Technology Collaborative, also an incubator startup venture studio at C&M's campus in Albuquerque. We again see the state bank bill. The common theme with those bills and a change from previous years is they're not funded by permanent fund dollars, but they seek general fund appropriations. We have updates and copies of submitted FIRs in the weekly report. If you have any questions or thoughts regarding our analysis, please let us know. Steve, your second item there is regarding clients. We do have a JPA draft now from Western New Mexico University. It's being processed, and their Board of Regents has approved an investment in our investment pools. Also, the North Central Regional Transportation District is looking to place some reserve dollars with the SIC. We're probably going to have 25 clients here by the end of Q1. Steve, that's the end of my comments.
Thanks, Charlie, and Commissioner, that is the end of my report.
Great. We'll go to council questions for Steve or Charlie. All right. With that, we will go to Vince for the CIO report.
Thanks, Madam Chair. Good morning, everyone. Well, let me pick up Steve's comments on recruiting and retention. We've had another resignation. Paul Chapman is leaving us and heading to another public fund. Let me pass 30 seconds over to Paul and see if he has anything to say.
Oh, thank you, Vince. Yeah, I've accepted the job. I'm going to be transitioning middle of the month. But I do want to thank the council and Vince and Steve. It's been a great experience working for New Mexico. I've really enjoyed the people that I work with. I've enjoyed my responsibilities. It's been a great learning experience. I'm just very appreciative of the whole experience. So thank you very much.
Madam Chair, this is Harold Lavender. I would just simply like to say how much the investment committee has appreciated Paul's work, how much I've appreciated his work. We're really sorry to lose him. Certainly understand when people make changes, but I want to wish him, Godspeed and only the best, and thank him for all of his wonderful work for us.
Same here, Paul. You have a steady hand and a lot of attention to detail. I'm going to miss you, man.
Thanks very much.
Yes. Thank you and good luck to you.
Okay, well, thanks, Madam Chair, for that deviation there. Yeah, let me echo what Harold said. Paul has just been a great member of our team and has done fantastic work for us. Really developed the real estate and real return portfolios from when he first came in. So very much good luck to Paul, and thanks for your service with us. Let me just close that out, Madam Chair, by just echoing Steve's comments. We lose folks on the investment team, at the agency overall, to retirements. That's something that's a given. We lose them to the private sector, which we go a little bit about, but we understand the private sector tends to have greater resources than we do, particularly for investment staff. But Paul's our third loss to another public fund, and that's pretty serious to me. That historically that hasn't happened often, and we've had our last three losses have been not only just in the past few months, but all three to other public funds. So our condition's serious in terms of staff size right now. I've got 7, 12 is my complement. So we're almost at half staff, and those folks are have left for other public funds. Good shops and good jobs within those funds, but that's a little bit unusual. Comments on the market. I think most folks have been noticing a little bit of volatility in the stock market. We've had a correction in the S&P 500. It's at minus 10% from its highs. In terms of impact on us, of course, it's slowed our NAV a little bit, as Steve has indicated. But we've had just a really great run. Stocks were compounding at 50% there for 12, 13, 14, 15 months around that time. So we've had a great run. We're having a little bit taken off at the top here. Actually, in terms of our asset allocation, it's actually moving us toward our asset allocation. So we were materially overweight stocks and also fixed income bonds, and underweight our private asset classes. Those two are starting to move toward our long-term target. So that's a bit of a silver lining there. And we are sitting on an absolute mountain of liquidity. So if this thing keeps going and we get down minus 20, get to kind of bear market territory, we have plenty of liquidity to rebalance, buy stocks at discount from what they've been selling, and continue to pay our distributions and so forth. So no, this isn't causing us any problems. It's certainly not a market movement that's unexpected. As we set up our asset allocation, 10% corrections are frequent. 20% bear markets are less so, but we're well outfitted if that happens to be the case going forward. Lastly, as you pointed out, Madam Chair, we've got a very extensive meeting for you today. I think a lot of credit to our asset class directors and consultants who've been out there, beating the bushes and finding these investments, and there's some very good ones in there. Very happy to have these presented to you for approval. So with that, Madam Chair, I'll stand for any questions you have, or we can move on.
Questions for Vince?
Madam Chair, this is Tim. Could I ask Steve a question?
Yeah.
Oh, thank you. And let me also echo all of the remarks about Paul Chapman. I also want to throw in there, thank you, Paul, for your patience with me and some of the crazy questions I've given you. But to Steve, I noticed on page 23 in your summary there on real estate that we haven't met our target. But on page 54, you're hoping to reach the target now by the end of 23. But with Paul leaving, is that time frame going to change? Where do you think that's going to take us over the next year or two?
Treasurer, did you mean to direct that question to Vince?
Oh, I'm sorry. I did, and I apologize to you, Steve. Vince, that question is yours. It's not Steve's.
Okay, thank you, Mr. Treasurer. I think our pacing's tracking along fine. Keith Sabo, who's been running fixed income for us, is moving over to Paul's spot. So it's that real estate real return is a big job for an asset class director, and Keith's going to move over and work on that portion of the portfolio. So I think he's got a couple weeks here yet with Paul to kind of catch up, and of course we have good consulting there with Townsend. I think we're on plan. One of the reasons we're underweight the real estate is the stock market is so strong and pulling the portfolio along and gaining weight within the portfolio because of its outperformance. That looks like it's slowing down here. I mean, we've had a little bit of a correction. I have a hard time seeing it take off again like it did, particularly out of the bottom there in March 2020. So I think those things are starting to equalize a little bit. We're getting plenty of capital calls from the real estate sector. I think we're still on track.
Okay, thank you, and good luck to you, Paul. I hope you do well.
Thank you very much. Oh, yeah. Any further questions for Vince, Paul, Steve? All right, so we're going to move into performance report. I don't know who we've got from RBK on the line, but Vince, I'm going to hand it over to you, and you can hand it to them.
Yeah, sure. So I mean, just a few brief comments on the stock market, but I think Marcia and Matthias have further information for you on the November flash report.
Okay, great. Good morning, everyone. And thank you, Vince, for the comments. Today in the packet, we have the November performance summary for your review. We'll keep it relatively brief, again, just given the agenda. And you will see December coming out later this week. So keep an eye out for that. And certainly it's going to be a little bit more favorable news there in December relative to November. We can take a look at page 21, as we always do in the meeting packet, that has a summary of the capital market details to always put the portfolio returns into context. In the bottom right table, you can see the market performance for the various trailing periods across the major asset classes, and they're always organized by equities at the top, followed by capital preservation, and then the diversifiers at the bottom, which historically haven't been all that meaningful, but in this inflationary environment, we've really seen them start to take off. And again, you have exposure through your asset allocation to all of these various asset classes, as Vince mentioned. So in November, it feels a little bit dated now, so I don't want to spend too much time on that. But even though the month started off well, it did end up selling off pretty meaningfully at the end there, just given heightened concerns on inflation that had been creeping up for some time, and then was compounded by the new COVID variant that we're now all collectively dealing with. That, of course, as has been the case in prior iterations, led to increasing hospitalization rates and some lockdowns and further restrictions. That's been a cycle that we've been in and out of for quite some time, and particularly internationally, which I think have been quicker to react to that. We've seen some of the economic growth, at least on a temporary basis, be more impacted on the short term, but the relative valuations as a result have actually become more compelling, and some of that post November has actually shifted in terms of market leadership there. So we did have a rebound in December, which was I think somewhat expected given the cycle that we've been in. Most of the indices ended up showing gains by the end there, and we had low to mid single digits for all the various asset classes. Value and growth, that has been a cycle that has also started to at least show signs of shifting. Within the fixed income market, there overall was positive global yields, but particularly on the longer end of the curve, started to shift down modestly, although that was short-lived. This year, it's essentially flipped, and we started to see rising interest rates, and that's put particularly pressure on the longer dated bonds. You do, again, as we talk about, frequently have a bifurcated fixed income exposure to traditional core fixed income, and then the non-core. The non-core is far less susceptible to interest rate risk or sensitivity to rising interest rates. That's by design, and you will see the differentiated performance there. So, as Vince mentioned, all of the strategic items that have been laid out in the investment plan over the years are really starting to play out more. And so you're well positioned for this environment that we're going into, much more so perhaps than this nothing but up environment that we've been in since then. So inflation's been high. We know that this week the Fed's meeting today, tomorrow, a lot of eyes on that in terms of what future interest rate direction and path will look like. They're obviously walking a bit of a tightrope there in terms of trying to balance not overshooting things, but also trying to figure out how to rein in inflation. And so this potential shift in policy away from supporting growth to fighting inflation is going to be a pretty critical one, a tricky one, and so there's a lot of eyes on that. And that's been primarily driving a lot of the market volatility that you've seen this year. So far, we are working through our capital market assumptions. We're almost done with those. As you'll recall, we do that on an annual basis to provide a sense of what forward return expectations might look like. And as we have those finalized and completed, I'm sure we'll bring an update to you in the coming months. So, in the interest of time, I'll stop here, see if there's any comments or questions. Otherwise, turn it over to Marcia for the portfolio results.
Thank you, Matthias. Council members, I'm going to ask you to go to page 23 of your diligent and look at the bottom. Again, this is a November flash report. And as a reminder, the flash report includes performance for public assets, but private assets are not valued. They're valued on a quarterly basis. So again, this is the final flash, but it's really preliminary performance for the quarter. And looking at page 23, you can see that it was a tough month. The total fund was down just under 1.5%. The land grant was down 1.59, and the severance tax was down 1.5. So on an absolute basis, a tough month. Also on a relative basis, we saw underperformance against benchmarks for the month, and I'll get to that more in just a second. Going to page 24 and 25, I'll just say that, as Ben said, you were underweight to some of your private asset classes, because especially the equity markets had continued to be strong on the public equity markets. The recent performance or down performance has brought you closer in line with your target allocation, kind of getting there the hard way. I will then ask you to go to page 26, and just kind of piggybacks a little bit on what Mr. Malice was saying. If you look at that top line, this is looking at the total fund, so everything. We have a beginning value that this is January 1st of 2021, so this is calendar year, so 11 months of 2021. But pointing out the net cash flow, again, that is obviously including inflows and outflows. So thanks again to the Land Commissioner, you have a strong inflow into the portfolio, seeing a net increase just by cash flows of that amount is unique. We don't see a lot of that. But you also have gains for the 11 months of just under $3.6 billion. So strong across the board. Last thing I want to cover is beginning on page 29, and this is, again, is looking at your composite performance. As I said before, it was a tough month. It was a tough month on an absolute basis. We saw down markets, but also on a relative basis, looking at your manager performance or your composite performance against the benchmarks for the month. was you underperformed, but again, these are long-term benchmarks. And I will say that when we are able to send out the December, that a lot of that was offset in the month of December. Absolute performance was strong, as was relative performance. So looking through to the calendar year and the last quarter, again, a positive performance for the fourth calendar quarter, and should see outperformance relative to the composite benchmarks. With that said, again, it's preliminary, no privates. So on page 30, you can see a lot of zeros there. That will be reflected when we come to you with the executive summary for the calendar year ended 2021. Matthias and I'll take any questions.
Great. We're going to go to questions from council on the performance report. All right, hearing none, let's move to agenda 3, and I'll turn it over to Member Lavender for the investment committee report.
Thank you, Madam Chair. To echo what's been said so far, we certainly had a busy and a detailed investment committee meeting. Each of these particular investments presented for the council's approval, recommended approval. Each of these was recommended for approval by the committee, and obviously we're willing to answer any questions that we can answer. What I'd like to do simply is turn it over. Let's get started because we've got a lot of stuff to take a look at. And our first one is 3B, Paul. Mr. Chapman.
Yes, good morning, everybody. Paul Chapman, Director of Real Estate Real Return here. Nino Carpenito from my staff is on the call. Seth Marcus, Andrew Bradley, and Stefan Hertenstein from Townsend. And I believe we also have by now Julie Solomon, John Ruan from Aries. And then we'll get over to Hannah Moriarty and Greg Fowler when we get to the FPA Apartment Opportunity Fund. And just to address very quickly Member Eichenberg's comment, between this month and next month, we've got, depending how we size these, we've got 4 funds coming forward, and they're going to add up to $350 to $400 million. So a lot of early activity in the year. And we had a monster quarter and year. I think our total return, I just saw some preliminary numbers. They're not reported yet, but you'll hear about the next month at the SIC meeting. I think we're 720 basis points above benchmark for the 4 quarters, which is just a count. Translates into over $200 million of alpha in a year in the real estate portfolio. So we're basically sitting at 10% allocation right now because of the growth of the value of the assets in the real estate portfolio. So with that, let's jump into Aries European Real Estate Fund 6. The materials for this start on page 52 of Diligent. Staff, in consultation with Townsend, recommends a commitment of up to €100 million to Aries European Real Estate Fund 6 for the SIC's real estate allocation. And this is a closed-end commingled fund that's targeting returns of 12 to 16% with a targeted fundraise of €2.5 billion. We have a long relationship with Aries European Platforms. We've invested in 3 of their offerings. In this series, with the opportunistic series, we're invested in funds 4 and 5, and in the value add series, we have a €75 million commitment to Aries European Property Enhancement Partners. Townsend did their usual excellent job on the cover memo and in detail report, and we have a lot going on today, so I'm just going to focus on a couple things here that caused me to recommend this fund. First of all, when we invest outside of the U.S., we generally limit ourselves to non-core strategies. The core space in Europe is very crowded. That means low returns with domestic capital, and it's not worth the currency risk, the regulatory risk, tax complications to compete in that space. However, in Europe, just as the core space is crowded with domestic capital, the non-core space is relatively less competitive. This creates good opportunities to buy broken properties, fix and sell to core buyers. In addition, certain segments of the European market lag the U.S. in terms of the quality and functionality of the existing stock. And I think the best example of this is probably in the industrial sector, where we generally consider Europe to be 3 to 5 years behind the U.S. in upgrading its industrial stock to adequately serve today's e-commerce needs. This is both in the area of these huge distribution centers as well as the so-called last mile distribution network. And also, Europe is much further ahead of the U.S. in advocating zero carbon strategies in the real estate sector, and its much older building stock across the board is in dire need of upgrading to modern standards to be compliant with net zero. Finally, you may recall from our 2021 structure study, which we presented in August of last year, that we plan to increase exposure to Europe from a range of 10 to 15% in the 2018 study to a range of 10 to 20% in the 2021 structure study. So now if you look at the diversification chart on page 5 of the cover memo, and that's 56 of diligent, you'll see that Townsend forecasts that we'll hit that 20% top end of the target. However, these projections just add in outstanding commitments with regard to distribution, so the 20.3 projection overstates our true exposure. But we are heading up in the direction that we want to take this portfolio. So that's all I want to say about Ares Fund 6. Seth, you can take it from here.
Thanks, Paul, and good morning, everyone. I hope everyone had a restful, healthy, and happy holiday season. So as Paul mentions, we're here to talk about Ares first, but really 2 real estate investments with both with existing managers. So quickly, by way of housekeeping, in both of the Townsend cover memos, we highlight the investment and the portfolio fit on a standalone basis for just a single investment, and also a couple parameters and an analysis on if both investments and commitments are approved today. Ares, as Paul mentioned, is an existing and well-known name within the portfolio, both in the real estate and real return, and private equity as well. So Paul mentioned the real estate exposure. We also have some debt, real estate debt exposure and energy exposure in the real assets portfolio. I would highlight that we're cognizant of this, and it sounds like it's a number of commitments, but across the real return real estate portfolios, it's about 7.2% exposure. And then that's on a fully funded basis, so well below our 35% manager concentration limit. But within with an organization, obviously we know and trust. So this investment would represent New Mexico's our second commitment of the year. Although it's January, we approved a $75 million commitment back in September. That was being counted towards our 2022 allocation. The timing for this Ares commitment is important to note. They have a scheduled first close with a fee break on February 1st, so just next week. However, given the New Mexico and Townsend and Ares relationship, if a commitment is approved today, then we will have approximately a month extension on that first close timing discount that we can achieve. So the Townsend pacing model for the 2022 annual plan calls for approximately $300 million of new commitments. And that's been consistent across past years as well, and that's in the non-core space. This targets our 55% core, 45% non-core weighting, as well as achieving that target return that was discussed earlier. However, we've accelerated commitments over the past couple of years and anticipate doing that again this year, given the opportunity set in front of us, as well as the managers that are out raising capital. So we've recently, and we will present this once we have full updated numbers. But we've recently looked at sort of accelerating our pacing a little bit and how that impacts the portfolio. It does not cause any compliance policy concerns. It will ultimately probably result in a bit of an overallocation, which would be something we would discuss with you all as well as staff. But something I think that we're comfortable with still within the range, the band that we target for real estate. And then ultimately sort of lower commitments in some years to sort of make up for outsized commitments over the last couple of years, including this 2022 vintage. So back to the fund, and given the name, we've discussed it a number of times in the past. I'll try and keep this brief and hand it over to the Ares team. But Ares 6 does aim to follow broadly the same investment strategy as its predecessor funds, targeting that 12 to 16% return with a leverage cap of 70%. The fund will largely invest in the residential sector, the logistics sector, and office, with the balance being invested in some alternative property types like data centers, life science, and self-storage. The fund will also primarily focus on Western European countries within the UK. That's Germany. Western European countries, including the UK, Germany, France, and Spain, with a small allocation to some other regions as opportunities present themselves. The investment strategy itself really focuses on three themes: platform portfolios, corporate and special situations, and then repositioning, redevelopment, and selective development. Each of these is explained in detail in our report, and I presume that the Ares team will talk about these in their presentation, so I won't spend too much time other than naming the sort of themes there. Ares comes with an experienced team, a strong platform, and established operating platforms, and really favorable sectors targeting that residential and logistics opportunities. So like any of our investments, we do highlight a number of positives, pros, comparative advantages that are outlined in our report, as well as potential issues and concerns. I think the risks outlined are not necessarily new or unique to this fund. We've discussed the allocator model in the past. It comes with an increased fee load, paying the joint venture operating partners, and this structure is similar to other allocators we've invested with. However, as noted in our report, New Mexico will pay overall a reduced fee to Ares, given the size, the relationship, and the timing here. That's mentioned in our memo as well. Additionally, we highlight the allocation issue as they have multiple strategies within the European market. This is also consistent across many larger, more established platforms that have multiple funds in a region or strategy. And we believe this is well mitigated, given it also provides strong deal flow, given the available capital to the firm. Additionally, we as an SIC investor are already invested in the value add fund, so we will participate in the deals regardless. It's just a matter of which fund ultimately it will result in being allocated to. The last risk, and I do want to just take a minute on this one, that we do highlight is the track record. And I would say this is probably the ultimate the risk that really generated our qualified rating at this point in the fund. So Ares performance has been challenged a bit on a relative basis when compared to the same vintage non-core European funds. Going fund by fund, Fund 1 was a strong outperformer, 2001 vintage, 37% return with a top quartile performance. Funds 2 and 3 were both largely impacted by the global financial crisis. They were levered a bit more than some of their peers, invested in a handful of secondary markets, as well as some development, which struggled during the post-global financial crisis time frame. And for that reason, those are third quartile fund performers. And then Fund 4, also a lower quartile performer at this point, and Fund 5 is a bit early, I'd say, but returning strong returns at a 16% fair market value and really top quartile. So the fund series, the dispersion of individual investments, is really what we dig into to ultimately look at the underlying performance. The returns are notable for exhibiting sort of a barbell approach, where some very large gains were offset by some losses, resulting in the performance shown in our report. Again, this is not, unique to Ares, but a trait of many opportunistic funds. And I think what is noteworthy and why we're here recommending the investment today is that a portion of the sponsor's capital that's underperformed, or those investments that can be attributed to the underperformance, are lessons learned. And I'd say that where they did use more leverage than others, they've right-sized that. They've come down on their leverage profile. The market that they participated in, where they had not as strong of a track record, are less of a focus today, or not a focus at all. And really, the overall track record from a firm perspective is pretty strong. So when we look at funds 1, 4, and 5, each have reached their target returns. Top quartile performers 2 and 3 were largely impacted by their timing, and can also be compared to some of the more higher risk subset within the non-core space, where some of those established managers, not Ares, but some of the other established managers, have produced a near or total loss during the global financial crisis because of the risks that they took. whereas Ares did generate a positive return. So as I mentioned, the leverage limitation has come down from prior vintages. Of note, the track record on an absolute basis was impacted by timing, and ultimately we do feel that the fund, the organization, is a high caliber real estate investment manager, and the SIC portfolio will benefit from adding this additional European exposure that Paul highlights. So I'll close it there and hand it over to the Ares team. I'll just remind everybody that Townsend approved the fund on both a standalone basis as well as a specific investment within the SIC portfolio. And we do feel that this is one that will will create additional diversification and generate outsized returns going forward relative to our benchmark.
So with that, I think we're going to go to Julie Solomon. And Julie, can you and John take over from here and take us through some highlights?
Sure. Thank you, Paul. Thank you, Seth. And thank you all for giving us the time. It's great to be back with you all. I'm here based in New York and joined by my partner, John Rowan, who is joining us from London. And on behalf of John, our European team, and all of my colleagues across Ares, we want to thank you for your partnership with Ares, with the real estate team for many years now, and the opportunity to talk to you further about Ares European Real Estate Fund 6. This follows the successful investments that you have made to the predecessors, Fund 4 and Fund 5. The fund will be managed by the same local European team as the prior funds and will continue to benefit from our long-standing and prolific experience in the region that John will walk you through. Alongside fellow investors in the fund, you gain access to one of the deepest and most seasoned teams in Europe that has been on the ground investing together for more than 2 decades. We have 60 real estate professionals in Europe's most dynamic markets that are an extension of your investment team. And this real estate team sits within Ares Management, which as of today manages $280 billion in alternative asset under management and investments across private equity, credit, real estate, and secondaries. And while we have all been tested in the recent years, we're very pleased to report that we have navigated through as a firm and as a real estate team with great strength and resiliency. And this is something that we believe is driven by the commitment, by the dedication, and the accountability of the people that John and I get to work with each day. And the scale and the stability, along with the investment capabilities, has been a real benefit to our investors. And we have seen this really come through in your real estate investments, each of which are meeting and exceeding the return targets that we set out when we came to present to you in the prior 2 vintages. So what I'd like to do now is hand the discussion over to my partner, John Rowan, who will walk you through more on the background of our team on the ground in Europe, as well as the investment themes and strategy that we'll be most focused on for European Fund 6. John?
Thank you, Julie, Paul, Seth, and everybody. Nice to be here from London. Just to give a bit more color on the background of our business. Julie mentioned we have 60 dedicated real estate professionals here in Europe. We are based here in London with our headquarters, but we have team members around Europe based in the key markets where we are also investing. So that's Paris, Frankfurt, and Madrid, to name sort of the 3 largest offices. We have been investing in Europe for 25 years. That's meant over 7 billion euros of capital we have invested into nearly 200 investments. So a depth of experience across markets, across asset types, as we've built our business since the mid-90s. And I think the critical point to that experience is not just about the lessons learned and improving how we invest. It's also the critical relationships to access investments in a competitive marketplace. But beyond sort of the bottoms-up advantages that we have here in Europe and the team that we've built, we are part of a global real estate business. That's really important. So we are full service here in Europe, European funds, European team, but every investment is approved by a global investment committee. And that comprises members in the US, in Europe, in real estate equity and real estate debt, but also members who are non-real estate partners from other areas within Ares. So that gives us a real, we think, advantage in terms of the perspective, the experience in asset selection, portfolio construction, risk management as we invest your capital. Julie has touched on the performance of your funds with us in the past two vintages, and really looking at this new Fund 6, we are continuing with the same team and the same strategy into this vintage. What we see as the most powerful and attractive investment opportunities in the market today, they continue to be in our two favored asset classes of industrial logistics and rental residential. Those two asset classes represented nearly 70% of Fund 5. We have already secured 3 investments which will be seeded into Fund 6. 2 of those are industrial logistics transactions, and 1 is an affordable rental residential strategy in the UK. So certainly the deal flow that we're already securing into Fund 6 is absolutely consistent with the themes and sectors that we want to invest into. We source most of our investments through proprietary relationships. That's the important part of having a local team across Europe and having been here for a long time. So, when we ultimately find the investments, the next real element is how do we unlock the value? And I think Seth mentioned we really have 3 types of deals that we do. One is where we've been most active is platforms and portfolios. And in industrial logistics and in rental residential, this is a very effective way to build scale, diversification, and economies and better management when you can build these portfolios in specific sectors or in specific markets. And when you get to that scale, there is a wealth of core buyers who want to own these diversified pools of assets. So our job is to create them. We also take advantage of corporate and special situations where there's good real estate trapped in bad structures. We clean them up, we unwrap them, we repack them, and sell them to core buyers. And finally, we will always buy, fix, and sell or develop buildings in undersupplied markets, which we think have attractive upside. Kind of to wrap up, how do we see a portfolio? Well, diversification is key. Each of our funds is typically between 15 and 20 investments, so well diversified. We have a cap that no investment can be more than 15% of any fund. We will be diversified by property type. As I said, residential and industrial logistics will be the spine of Fund 6, we believe. And by geography, we're focused on those large economies in Europe, UK, Germany, France, and Spain. And within those, it's really the large gateway cities where the majority of our investment will be. Finally, the structure of the fund is a standard within the European context, Luxembourg vehicle. The terms and structure are very similar to our predecessor funds and have been reviewed obviously by your council. So with that, I'll kind of pause, and again, thank you for your time and your support over the years, and we'll be delighted to answer any questions as necessary.
Thank you, Mr. Ruin, and thank you, Ms. Solomon, for being with us today. So at this time, we're going to go to council questions on the Ares investment recommendation for either our own staff, Townsend, or the Ares representatives. Any questions?
Chair, this is Tim.
Yes.
And I've just got a quick question. I don't care who takes it, but on the ESG, where it's considered limited, can you go into that a little bit more, just for my edification as to what limited means? I saw the definitions, but you really don't go into limited much.
Sure. This is Seth. So that's in our Townsend report, and thanks for pointing out there are definitions in the back. So our ESG ratings are formulaic, and there is a sort of a direct rating, I guess, to each manager. they get points for certain initiatives and deductions for others. I think this one was actually right on the line of limited to integrated. So most funds come in at that integrated level, and ESG for many of these managers is both a focus and also we believe in Europe more of it's a little bit more robust than here in the U.S. But we do put through our sort of anticipated rating for the portfolio. I think that in this case, it was right on to my point, it was right on the borderline of being integrated or not. And I think that over the course of the investment period, it could easily be re-rated and moved up to integrated based on some of the changes we anticipate.
Okay. Thank you, Seth. Sure. Thank you, Madam Chair.
I'm wondering if anyone from Aries...
Madam Chair, it's Harold.
Yes.
I just wanted to thank Tim for bringing that up because, as you remember, the council did pass, I'm not sure whether it was a resolution or exactly what it was called, but policy that we would consider ESG when we're looking at investments. And so that's important. And thanks, Tim, for bringing that part up.
So for the council members, we're talking about page 68 of the packet. And I'm wondering at this time if either of the representatives from Aries would like to address their ESG policy.
I'm very happy. Just with regards to this is John Rowan, with regards to our investment strategy, ESG is an integral part of what we do, and I would say we have made significant investment both internally within Aries as a alternative manager with regards to our policies, our procedures, our protocols, and dedicated ESG professionals within our team. But more specifically, when we're looking at our investments, what is clear to see is that whether it be the environmental, the social, or the governance aspects, these are becoming very important to tenants, right, to attract tenants into space, but also to end investors, the core investors we're looking to sell our investments to. This is a key part of their assessment of the long-term value of a building. So every investment we do, before we've even made the investment, there is an ESG screening. So we do an assessment from the initial pipeline through to a detailed due diligence before we acquire an asset, which then leads us into a key component of every business plan, which is how are we addressing and improving and maximizing the ESG requirements or constraints within an individual property or investment. That then is something that we can measure and manage and ultimately drive that through to the exit, which, as I said, we see as critically important. The biggest area of focus, quite frankly, is around the E, right, and specifically is around energy and energy consumption. So there, ensuring that all our buildings are as energy efficient as possible, and if we are developing or redeveloping any buildings, making sure that our assets get the highest level of environmental accreditation when completed, whether that's a LEED or BREEAM, and there's a number of these different certifications, and again, we target those. And if we look at the first three investments that we are committing to into Fund 6, each of which is delivering brand new real estate, right? And those new real estate will have these higher levels of energy efficiency and environmental impacts versus older buildings. And that certainly I can see as a continued trend of us focusing on newer real estate rather than older, which has some constraints.
Thank you. Further questions from the council? Hearing none, I'll go to the chairman of the investment committee for a motion.
Madam Chair and fellow members of the council and those on the phone, you're going to hear my voice a whole bunch in this process, and I apologize for that because of the boilerplate. But anyway, we'll get started. Under 3B, based on the recommendations of the Council Investment Committee, advisor, the Townsend Group, SIC staff, and general fiduciary oversight of RVK, I move that the State Investment Council approve a commitment of up to 100 million euros to areas of European Real Estate Fund 6, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
It's a proper motion. Do we have a second?
Second, John Bingaman.
Okay, we've got a motion by Member Lavender, a second by Member Bingaman. We're going to take a roll call vote on the Ares European Real Estate Fund 6 recommended investment. Andy?
Commissioner Garcia-Richard.
Yes.
Treasurer Eichenberg.
No.
Mr. Lavender.
Yes.
Mr. Rawson.
Yes.
Ms. Allen. Ms. Allen. Mr. Bingaman.
All right, unmute. It's yes, Kathy.
Ms. Allen is a yes. Mr. Bingaman.
Yes.
Madam Chair, the votes are 5-1.
And have we been joined by any other SIC members in the meantime? All right, so with that, we have an approval on the Ares investment. Thank you all so much for being on the line with us.
Madam Chair, this is Ken.
Yes, Mr. Treasurer.
Thanks. Usually Harold asks me why I voted no, and on this particular one, it was, I love the fact that everybody recommended it, but I just kind of felt the leverage was high. I was a little concentrated for me. The key players and retirements, everything was just bumping the ceiling, and that's why I just felt that maybe this is not the one for us. So that's why I voted no, Madam Chair.
Thank you.
And I hope you all 100% right when you voted yes, and that we make a lot of money on this.
Okay, great. I appreciate you explaining yourself. All right, we're going to go on to investment item 3C. So let's turn it over to Mr. Chapman. This is our SPA Apartment Op Fund 8.
Yes, thank you, Madam Chair. This is going to be my last opportunity to get a yes vote from Member Eichenberg, so I'm really going to try hard here. The materials for FPA Apartment Opportunity Fund 8 begin on page 117 of your materials, starting with the Townsend cover memo. Staff and Townsend recommend a commitment of up to $100 million to FPA Apartment Opportunity Fund 8. FPA is targeting a $1.35 billion fundraise for this closed-end, commingled value-add fund. The fund will acquire undercapitalized, undermanaged suburban Class B apartments in major U.S. markets. FPA targets net returns of 12% for this fund strategy. The fund plans to have a single close on March 1, 2022, and is expected to be oversubscribed due to its history of top quartile returns in this fund strategy. New Mexico State Investment Council has an existing relationship with FPA through our commitment of $100 million to their Core Plus Fund 5. In fact, part of the rationale for committing to the Core Plus Fund was to gain access to their value add series, which is, as I mentioned, got quite a successful track record. Again, Seth will do the heavy lifting on describing their strategy as well as their underwriting of the fund and sponsor, but I do want to make some comments on how this strategy is consistent with our overarching objectives set forth in the 2020 structure study. First, the structure study sets out a strategy of reducing our core exposure from the current level of 65%. It's actually now 63% with the 3Q numbers, to a range of 50 to 55%. So this proposed commitment, together with existing unfunded commitments and expected upcoming commitments, sets us on that path. Second, the structure study targets growing our apartment exposure to be neutral to overweight in this sector relative to our Odyssey benchmark. Here I point you to page 5 of Townsend's cover memo. This is 121 Diligent, which shows our exposure by property type. This shows that we're currently underweight the multifamily sector on an NAV basis, but that the FPA commitment, together with outstanding commitments, should bring us close to the Odyssey benchmark exposure. I should also point out the benchmark itself is a moving target, as we expect to see multifamily, industrial, and alternatives grow within the Odyssey Index, and for office and retail to continue to shrink. Lastly, I'll point out that FPA's particular strategy for this fund is a good diversifier for our portfolio in that it targets assets that are more in the workforce housing sector of the market, as opposed to the A- and A apartments that comprise much of our multifamily portfolio. So Seth, can you describe to the council your underwriting?
Sure, and I'll I apologize again for your hearing my voice, as others mentioned. So FPA, an existing manager, as Paul mentioned, we are recommending a $100 million commitment here. And our commitment to the Core Plus Fund 5, our prior exposure to FPA, interestingly, was the last in-person meeting back in February of 2020, where both the individuals from FPA on the phone were in Santa Fe directly, along with the rest of your team. So that investment, just as an update, only began calling capital in the summer of 21. So it doesn't have any meaningful performance to report at this point, but is performing as expected and anticipated to actually outperform given the multifamily sector. So maybe specific to the fund, as I described the portfolio a little bit in my prior comments, the fund specifically, as described in the name and our memo, is a dedicated multifamily fund that targets non-core or value-add assets across major markets in the U.S. The primary strategy includes opportunistically acquiring undercapitalized, undermanaged, really suburban, what we call B apartments in major markets that are categorized as by job and population growth that are above the national averages. So FPA 8's target multifamily product is a bit older, lacks maybe the high amenities, and the business plan requires just a bit of modest capex to repair, renovate, reposition, add some amenities, where you can grow and command additional net operating income, which is ultimately rent, to produce their outsized return. So FPA targeting that 12% return while utilizing 60 to 65% leverage. And as Paul mentioned, this will bring us to the market weighting for multifamily at the current exposure. We anticipate that to increase as well. We highlighted a number of positive attributes in this fund in our materials, but the experience, the strong sponsor, they've been doing this for over 35 years. The management team has worked together for over 20 years at FPA directly. And this experience has resulted in a well-established network of working relationships with both brokers, owners, sellers for sourcing, agencies for relationship bank debt and lending for financing that has really resulted in top quartile performance and track record as outlined in our report. To elaborate a bit on the organization, FPA is a vertically integrated business model and is an owner-operator with firsthand local experience, networks, timely market intel through its property management and construction affiliates with over 1,200 employees across 7 offices. The firm comes with strong alignment given the ownership and the co-investment, the sharing of investment profits with employees, the captive affiliates. So basically they do direct property management, but they do not take on third-party contracts. That property management is exclusive to the assets that they own. As with any investment we bring here, it does not come without a couple of risks, but we feel these risks are very well mitigated. The firm is 100% owned by Greg Fowler, who you'll hear from shortly, and you met back in February of 20. This risk was considered 2 years ago, remains the same today. And we believe that there is a really deep team under Mr. Fowler, and we see this as more of potential platform disruption risk at some point in the future when ownership is either expanded or monetized. Regardless, the fund does have a meaningful key person provision tied to Mr. Fowler directly, meaning that investors can dissolve the partnership if he was to no longer spend enough time or attention on the fund. Further, and I think this is actually very important, the investment committee decisions are require unanimous approval. So any member of the investment committee individually technically has a veto right on decision. So it is a very collaborative investment process. The other risk identified is the inclusion of student housing in the fund with an up to 25% allocation there. While this is a unique asset class, it is a subset and to the multifamily sector. FPA has invested in student housing, has a good track record there, although largely unrealized. And generally speaking, student housing has been a good investment, just not as good as multifamily. So therefore, slightly dilutive to the overall performance when we look at an attribution analysis. However, still strong and still achieves the target return based on the projected performance. So I'll stop here and remind everyone once again, this has been approved by Townsend's investment committee on a standalone basis, as well as on behalf of the New Mexico real estate portfolio. And I'll hand it over to the team at FPA.
Good morning. Thank you, Council, and thank you for the kind introductions. This is Greg Fowler. I'm the founder of FPA. We're a little unique. We started with a fourplex that I bought during college and fixed up myself. And then I went in the brokerage world and really learned how to buy and sell assets and through that way, and got to see a lot of other people's mistakes, especially in that late 80s time when a lot of buildings went back to the bank. So that's made us conservative. I think some of the things to point out are we've done 125,000 units, but we also have over 85,000 realized units, meaning we went end to end on our investments. So we bought close to 700 buildings, and we have 490 realized buildings, or another 20 in the hopper to sell. Our typical hold is only typically 3 to 4 years. So we're typically buying something usually from off-market private sellers or long-term institutional buyers that have owned it 10 or 12 years and have kind of lost interest in the asset. We call them orphan assets. They entered a market and never got scale, so they didn't focus, and the person that did the deal is long gone. And we're typically spending $5,000 to $15,000 a unit upgrading the flooring materials, putting in high-speed internet, especially in our first-generation projects, so that the kids will be sticky with the families, providing homework areas, partnering with local nonprofits to provide tutoring and SAT prep or after-school programs. And then we're trying to really orient the improvements towards the tenants that are going to live in the building. We've got 6 offices, San Francisco, where I am today, Irvine, California, Denver, Dallas, Atlanta, actually 7, DC, and Chicago. And we're unique in that we write on every listed deal in the country, but that's only typically 10 to 20% of what we buy, and probably 80% of the offers we make are on listed deals. And we do that so the brokers think of us when special opportunities come up. And then we write typically about 3,000 off-market offers a year, which we only get about 1% acceptance rate, but that's a lot better than our listed, where we get about 1/10 of 1%. And what we like to do about buying off market is we usually have more time to do the deal. We're not in a overbidding situation. And we are typically going proactively to deals that we think could use our capital and management expertise to turn them around. And I'm sitting across the table across the table from sellers. I was in DC on Sunday meeting with a private family that's owned a building that they built since the late 60s. And that's how we've been able to get most of our deals. And we've got people across the country. So we have 6 acquisition officers, and they're backed by 10 analysts. So it really is a tremendous amount of work to get the deals we get. And we don't chase deals, meaning we write using our exit caps, our rent growth that we're comfortable with, our capital. And we're also unique in that the construction group and the management group have to sign off on our budget so that they believe in it. So we're not forcing the rents or the rehab to people that don't believe in the numbers. I also want to point out our co-invest in this fund will be $65 million, and $50 million of that is coming from me personally. So, I have real skin in the game. This is my number one investment, and basically where all my liquidity goes. And that we have a 9% pref, so there's no promote to us until you get a 9% IRR on your money. Things are pretty crazy right now in the real estate market. We still have funds in Fund 7, so that'll probably take most of the rest of 2022 to invest. But we're really looking for a 4-year commitment. So really 2023, 2024, 2025, and 2026. So this puts you in position to put money out, as the stock market corrects and as interest rates go up and kind of reset the market. So we're hoping to do that when things have calmed down a little bit, because it's been a little bit crazy this past year. And we've been huge sellers. We sold over 40 buildings last year. Our track record is very realized. Our Fund 1 is fully realized, our Fund 2 is fully realized, our Fund 3 is fully realized, our Fund 4 is fully realized, and our Fund 5, which was 2015 to 17, has one asset which is non-refundable, so that will be fully realized. Our Fund 6, which was 2017 to 19, we've already returned 68% of the investor's capital, and we will have all the capital returned this quarter with deals non-refundable, and we'll still own about 50% of the portfolio. And even Fund 7, which we're currently investing, we've already had one realization, have another one pending, and 4 more under contract. The buyer's emit one non-refundable, so I don't want to count them as sold deals. And then I think as far as the group's comments on ownership is that the bottom line is that 60% of the profits go to 80 employees of the company. So I had 2 partners who I bought out both of them, and we are developing a young team, and most of the people we're looking at are in their 30s. So that we're really looking at developing a young team when I want to hand the reins over, but I'm planning on staying, at the helm of the firm for at least 15 years. So we probably start that transition in about 10 years. But the people are very well compensated and share in both the profits of the manager company and in the promote. And even though they're getting 60% of the profits, the employees, they're putting up about 15% to 20% of the co-invest. I'm putting up the vast majority, but everyone's got skin in the game. So every regional manager, every construction manager, every maintenance manager, who are all so critical into what we do, are investing alongside of you. And believe me, these are big investments for these people. This is, substantial. And, the biggest problem we've had is we've had a lot of people retire because they've done very well in the series of funds and with all the realizations we've had. That's really, I think, the main things I wanted to pitch. I think we were the 29th largest owner of apartments last year, but our deal is not to build up assets under management to get large. And we're also not looking to sell the firm. We've been offered by many, many people to sell the firm, and we just have no interest. And we want the control, and we want the income to be there to grow our business and to be able to invest alongside our partners. And we've got about 20 of the top 50 endowments that have invested with us, and 10 of the top foundations, and then many public plans, and are really excited to build a relationship with you all, and really appreciate your consideration, and hope that you'll vote to invest with us again. Thank you very much.
Thank you, Mr. Fowler. All right, we're going to go to questions from committee, like I said, for either our staff, Townsend, or the representative from FPA. Questions from committee? Okay, I'd like to go to Member Lavender for a motion.
Thank you, Madam Chair. Under 3C, based on the recommendations of the Council Investment Committee, advisor of the Townsend Group, SIC staff, and general through Sio oversight of RVK, I move that the State Investment Council approve a commitment of up to $100 million to FPA Apartment Opportunity Fund 8, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Do I have a second?
Second, John Bingaman.
All right, we've got a motion from Member Lavender, a second from Mr. Bingaman on a recommendation on the investment to FPA. If I could have Andy call the roll, please.
Commissioner Garcia Richard.
Yes.
Treasurer Eichenberg.
Yes.
Mr. Lavender.
Yes.
Mr. Rawson.
No, but I'll change my vote to yes for Paul.
Ms. Allen.
Yes.
Mr. Bingaman.
Yes.
Madam Chair, the motion carries 6-0.
All right. Thank you, Mr. Fowler, for being here to represent your company.
Thank you very much, and I promise you I'll do my best for you. I really appreciate it.
Very good. Okay, we're going to move to away from our real estate recommendations and on to one of 2 non-core fixed income recommendations. So I will turn it over to Mr. Zabel, and you can talk about your memo and then hand it over to Axia and the representatives from Arbor Lane if we've got some here.
Good morning, Madam Chair. This is Keith Zabel speaking, wearing my fixed income hat today. We have two items, as you pointed out. One is a $150 million commitment to Arbor Lane Credit Opportunity Fund 3, and the second is a little more simpler. It's a contract renewal for the Shankman high yield short duration portfolio. I have a small army as a supporting cast this morning of world-class investments from the GP today. We have Rochelle from, Rochelle Udogu rather, from the GP Arbor Lane, joined by Bob Frantz, one of the founders, and Dan Galenter, one of the partners of the firm. I also need to acknowledge the help received from Matthias from RBK related to his help on the Shankman renewal contract. And then finally, we have a large contingent, as usual, from Axia, and the point person for that group will be Trevor Jackson, as usual, and I'll have him introduce his team when we hand over to him. To jump right off, we'll start with the Arbor Lane recommendation. NMSIC staff, in consultation with Axia, recommends a commitment of up to $150 million to the Arbor Lane Credit Opportunity Fund 3. The New York GP was founded by Bob Frantz and Ken Hoffman, who collaborated to start the firm in 2016 when Credit Suisse exited the $3 billion credit business that they ran for the bank. The strategy for the portfolio is one that targets an IRR return of approximately 15%, and the fund will invest in distressed corporate credit, primarily in the United States. Arbor Lane seeks to earn its target return by investing in a mix of stressed performing and distressed opportunities, where opportunities driven by the opportunity to deploy capital that is tied to special situations linked to the credit counterparties, rather, demand for liquidity. Typically, stressed performing situations are undervalued top of the cap structure positions that offer downside protection with upside opportunity. I'm sorry, I lost my place here. Typically, stressed performing positions are in undervalued top of the capital stack structures where there's opportunity. My apologies. Typical stress performing positions are in undervalued top of the capital stack structures where the GP's analysis, here we go, analysis indicates strong likelihood of full payment. Distressed positions are secured debt offerings with downside protection and upside opportunities that are driven by the restructuring of possible restructuring of the debts. Although not a distressed opportunity or distress for control investor, the GP does seek seats on bankruptcy restructuring committees in order to influence value creation through the restructuring process. To summarize really briefly why we like this particular investment, number one, we have a very seasoned team with significant experience in the leveraged loan markets, and more importantly, large amounts of experience and history working together. Prior work at Credit Suisse has enabled the team to build a network of very strong connections that are uniquely valuable in deal sourcing. Another key point is that the GP is very conservative in its underwriting of portfolio construction and on the individual position underwriting. The market, importantly, is presenting a significant set of opportunities. Currently, if you value the distressed performing and or stressed performing and distressed portion of the market, define that as loans that are trading at 86% of par or below. The opportunity set in front of the fund is something on the order of 100 times the intended value of the capital raise. What's driving the large size of the opportunity set is in part an exploding amount of loan issuance tied to high demand for CLO issuance. Underwriting standards on loans underlying the levered loan space and CLOs generally has also been declining over the course of the last decade. And Axia and the team, I'm sure, will address those issues as well. That's the summary, and I will turn over at this point to Trevor Jackson to deliver the Axia underwriting.
Thank you, Keith. Good morning, Madam Chair and members of the SIC. As Keith mentioned, today we're bringing Arbor Lane for discussion. I have a number of members of the Axia team on the line. Just a couple of brief comments. As Keith mentioned, quality manager with a very experienced team, which you have on the line today. From a category standpoint, distress and other is a core category for the portfolio. And so in general, you'd have an allocation to it, but even more so in this current market environment, being the current pandemic and post-pandemic, whenever that truly is, there's just a lot of opportunity for distressed and stressed opportunities out there. Dislocation is going to occur. We know that's going to be the case, and we want to be able to have portfolios of managers that can take advantage of that. Steve and Vince made great comments about growth in the portfolio overall over time, and pacing really reflects that. So putting more dollars into the ground is important, and Arbor Lane is another step towards that. And we'll be coming back to you with increasing pacing to kind of get you up to target. So in general, we really feel this is a nice category to be in. You already have some distressed exposure, but again, not too much given kind of our bands that are there. And I will let the rest of the team kind of talk about the strategy itself. With me today is Timothy Nest, who's partner and head of credit at our firm, as well as on the investment due diligence team. I also have Simon Fletgate, who heads our ODD, operational due diligence, and Ryan Hawthorne available to answer questions for the group. So I'll turn it over to Tim to kind of walk through the strategy.
Okay, thanks, Trevor and Keith. I'll try not to be too redundant with some of Keith's comments, but we recently reviewed Arbor Lane Credit Opportunities Fund 3 for consideration of the non-core fixed income portfolio. As always, we completed investment due diligence, operational due diligence, and an ESG review on this manager and the opportunity. In terms of the firm overview and background, as Keith mentioned, the firm was started in 2006 by Bob France and Ken Hoffman following the sale of Credit Suisse's proprietary distressed portfolio when the bank really decided to exit the business. It's a team that we've been following since their departure from CS, given their strong market reputations. Despite the fund naming convention, Arbor Lane raised its first fund standalone investment manager in 2018, Credit Opportunities Fund 2, and is really in the later stage of the Fund 3 raise, which we're discussing today. As part of Arbor Lane, the team has really continued its strategy of stressed and distressed investing in North American corporate issuers predominantly, with a really focus on senior bank loans and mid-sized capital structures. In terms of the team, they employ over 20 professionals, split somewhat equally between investment and non-investment professionals. The investment activity is overseen by the general partners, two managing partners, Bob and Ken, who, according to their GP materials, have supervised the team of over 100 professionals and oversaw approximately $25 billion in gross risk across Credit Suisse's global credit business. Overall, we'll say there's been great continuity across the team, and there's solid sort of alignment with the team and the principals, and they've also had a few of their CS colleagues join the Arbor Lane platform since they commenced. As Keith mentioned, there's really kind of a few key verticals here. There's stress performing investments where they're buying sort of senior discounted loans and bonds at in some of it discount to face value. They'll look at some restructuring opportunities where they'll seek to buy the fulcrum security, typically at the top of the capital structure, and lead or influence the restructuring process. And lastly, they'll look to do some rescue or new money financing to sort of stressed businesses. Overall, the fund is targeting 15+% net IRR, and overall generating some solid returns in Fund 2, albeit a little bit earlier in the overall track record as part of Arbor Lane. Primary terms for Fund 3 are as follows: target capital raise of about $1.5 billion, and we're quite on the way to that target. 3-year investment period, 2-year harvest period with some. And I would note that standard fees are management fee on committed and invested, and 20% carryover and 8% hurdle. That said, New Mexico is expected to pay around 1.2 fees just on invested capital, which is good savings to the headline fee structure. So what do we like about this opportunity and the team? First off, as everyone's mentioned, we believe there should be a stressed and distressed market opportunity in the years ahead, between sectors that remain impacted from supply chain issues, inflationary pressures, geopolitical issues, just to name a few. And the team has a great pedigree, distressed investing experience, and most of the team members have more than 10 years experience with a team, a senior team averaging over 17 years in distressed investing. The team's long-term track record is quite strong. We understand that the investments during their CS time have performed quite well. That portfolio is ultimately sold to a competitor, and the team has been helping sort of that wind down. And equally, Fund 2, as I mentioned, has performed quite strong to date. We believe that our strategy of focusing mostly on first lien positions is downside protected despite the high return profile. And finally, and importantly, we believe the ultimate economics and management fee side are competitive for what is, we believe, a fairly tough to execute strategy. Of course, there are different sort of investment considerations that we raised in our diligence, a couple of which I'll highlight. There is some element of sort of key person risk here, given the importance of some of the sort of senior individuals. We note, though, however, that the continuity and the stability of the team to date, the amount of time and money that they've all sort of invested to build this platform, we think makes them quite aligned with LPs in their investment products. And it's also worth mentioning that they sort of have expanded a bit to focus on some lower returning deals, mostly with SMA capital, but that theoretically could be sort of a stretch on the team's time. There, we mitigate saying that we do think it's actually synergistic, the different strategies that they're looking at and having different pools of capital, while we do expect that they would sort of add investment resources to the extent that any further activities developed in sort of parallel strategies. So overall, and notwithstanding some of the considerations I just mentioned, we believe Arbor Lane is well positioned to take advantage of an attractive opportunity set and quite additive to the broader New Mexico credit portfolio. So we're happy to address any questions you may have now, or if not, I'll pass it off to the Arbor Lane team. I think if there's nothing, I'll pass it over to the team.
Okay. Well, thank you. And thank you all, very much, for the time and consideration. We very much do appreciate that. As mentioned, as way of background, we started Arbor Lane about 6 years ago. Before that, I ran the overall credit trading business at Credit Suisse, which was in excess of $25 billion of risk across investment grade, high yield, leveraged loans, global distressed, parts of structured credit, but where Ken, myself, and the team spent the vast majority of our time was in managing the firm's principal or prop book. Since leaving, Credit Suisse, we've been, focused and investing in exactly what we've been doing, for the past 20 years, which is investing in off-the-run, private, middle market, stressed and distressed, bank loan opportunities. These are senior secured, top of the capital stack opportunities in mid-cap structures and we focus across, both stressed and distressed opportunities. I think, we've been very fortunate in the segment of the market that we focus on. As I always said, this is the most underfollowed, underinvested, under-researched segment within all of credit. And while, sourcing and finding the opportunities can be, more cumbersome for others, I think we've developed a market leadership position in the space. And, we firmly believe as we look out on the next 3, 5, 10 years, the opportunity set, is incredible. Obviously, there's been a ton of over-levered credit that has been created over the past 7 or 8 years, largely via, CLOs, some within the commercial banks and the regional banks, some within the direct lenders, right? And I think we are very well positioned because of our market leadership, to take advantage of that opportunity. The team has been together for a very long period of time. We've refined that process over the past 20 years, and we feel very, very confident, about the opportunity set in front of us. Again, we really, very much appreciate all the time and effort that's, went into this.
So am I speaking with Mr. Friend?
Yes, that's correct.
Okay. All right, great. So at this time, we're going to go to committee questions. All right, hearing none, I'm going to go to Member Lavender for a motion on the Arbor Lane investment.
Thank you, Madam Chair. Based on the recommendations of the Council Investment Committee, Advisor Axia, SIC staff in general, fiduciary oversight of RVK, I move that the State Investment Council approve a commitment of up to $150 million to Arbor Lane Credit Opportunity Fund 3LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Is there a second?
I'll second that, Chair. This is Tim.
All right, great. So we've got a motion by Member Lavender, a second by Member Eichenberg. And with that, we're going to have Andy take a roll call vote on the Arbor Lane Credit Opportunity Fund 3 investment recommendation.
Commissioner Garcia Richard.
Yes.
Treasurer Eichenberg.
Yes.
Mr. Lavender.
Yes.
Mr. Rawson.
Yes.
Ms. Allen.
Yes.
Mr. Bingaman.
Yes.
Madam Chair, the motion carries all in favor 6-0.
Thank you very much, Andy, and thank you to Mr. Flans for joining us from Arbor Lane.
Thank you very much. We very much appreciate it.
All right, Mr. Sable, we're going to go on to the contract renewal with Shankman Capital Management.
Great. Madam Chairman, thank you very much. Hopefully the oil can applied to my tongue in the intermission here will make this flow a little bit more smoothly than the last presentation. SIC staff, in concert with RVK, recommend the renewal of a contract for Shankman Capital Management to manage a short duration high yield strategy to continue in effect as long as the parties mutually agree. The contract, as is conventional, can be exited upon 30 days of notice to the manager with no penalties or additional fees. The current investment contract expires in March of 2022. By way of background, the SIC engaged Shankman to manage this strategy in March of 2018. Since that time, there have been no adverse developments of any sort. The strategy is a very short duration strategy focusing on a unique set of opportunities that present around the financing of high yield bonds, actually refinancing of high yield bonds due to maturity, callability, and other corporate events. Shankman follows a particularly conservative and disciplined approach to its portfolio management. As you will find on page 2 of RVK's manager profile, the manager's performance has consistently been top decile Sharpe ratio over the life of the investment vehicle or the investment mandate, which is to say it has extremely strong risk-adjusted returns over that time frame. That's a quick summary, and I'll hand it off at this point to Matthias for any further comments.
Thanks, Keith. I think you addressed all the main points. The only addition that I would make is from an economics perspective. Also very attractive. They're essentially the most cost-efficient strategy in their particular peer group. So not only are you getting very attractive risk-adjusted returns, they capture about 60% of the upside while only participating on about 40% of the downside. That's what's driving that attractive Sharpe ratio. But you're also receiving that type of performance at essentially the lowest cost.
Great, thank you for that summary, gentlemen. Any questions on this contract renewal from the committee?
Madam Chair, I've got a couple. This is Tim. I was just wondering, I mean, I look at this and go, why are we recommending to retain them? Is it more expensive? Is it more costly to try to find somebody new? What's our reasoning for doing this?
This is Keith Sable speaking. The key points on this are within the strategy niche that they're asked to manage. Their Sharpe ratio is top decile, which is to say the risk-adjusted returns are among the best available in the market. And the second component, as Matthias had mentioned, is the fee structure is extremely compelling. And so the combination of those two says we realize net returns that are among the best available in this space.
Wow, kind of between a rock and a hard place, huh? Okay, thank you, Madam Chair.
Further questions? Do we have a motion?
Madam Chair, based on and consistent with the recommendation memo set forth in the public meeting materials, I move that the State Investment Council approve the renewal of the contract for Shankman Capital Management for as long as the parties mutually agree.
Madam,
Mr. Treasurer.
Madam Chair, could, well, let me see, get a second first, I'm sorry.
Do we have a second on the motion?
Second, John Bingaman.
All right, so we've got a motion by Member Lavender, a second from Member Bingaman, and it sounds like we've got discussion on that motion. Mr. Treasurer.
Thank you, Madam Chair. I would just ask that we amend the motion to a maximum of 5 years so that we look at this again.
Okay, so we've got a proposed amendment on the motion rather than for as long as...
I would love to, yeah. Madam Chair, I'd love to see an amendment to the motion instead of...
I would second that motion, Mrs. Lee.
All right, so we've got a proposed amendment and a second on the amendment to change the term to a 5-year term.
Just to clarify, Keith Sable speaking. Perhaps it would make sense to ask Vince to comment about the rationale around the indefinite extension as it's related to some contract expirations that took place during the March timeframe of last year.
Thanks, sure. Yeah, so several months ago, we brought before the council the idea of these the contracts with these publicly traded managers where our securities are liquid, and there tend to be ongoing relationships with these managers to just have an auto renew type contract with them. I believe we held a vote. I'd have to go back and look, and that passed with the council agreeing to do that. So that's why you're seeing this open-ended, but with 1 month termination type of contract.
This is Harold. I'd like to clarify also what Tim has moved. The amendment, my understanding would be a maximum of a 5-year term with the same 30-day cancellation provision still in place. Is that accurate, Tim?
Yes, it is, Harold. I just want to put a limit to it so it comes back before the council.
So since we have a motion for an amendment and a second, I'm wondering if we should vote on the amendment first.
I believe that's correct, Madam Chair.
Is the amendment clear to all the council members?
Would you restate it, please, Commissioner?
I'm going to have the treasurer restate it.
Thank you, Madam Chair. I just didn't want this to run for as long, so I'm just putting a 5-year cap timeline on it. So it expires in January of 2027.
Thank you.
Yeah. So the original motion said, I move the State Investment Council approve the renewal of the contract for Shankman Capital Management for as long as the parties mutually agree. And then we could just add up for a term of up to 5 years.
That'd be great, Madam Chair. I can live with that.
Is that something the council understands and is ready to take a vote on? We've got a motion and a second on that amendment. Any questions on the amendment? All right, Andy, if I could have you take a roll call vote just on the amendment, adding for a term of up to 5 years to the motion.
Commissioner Garcia-Richard.
Yes.
Treasurer Eichenberg.
Yes.
Mr. Lavender.
Yes.
Mr. Rawson.
Yes.
Ms. Allen.
Yes.
Mr. Bingaman.
Yes.
Madam Chair, motion carries 6-0.
All right, so we do have an amended motion now. So we're back on the debate of the motion. Is there any further discussion on our amended motion? All right, so if we could have Andy take a roll call vote on the amended motion.
Commissioner Garcia-Richard.
Yes.
Treasurer Eichenberg.
No.
Mr. Lavender.
What?
Yes.
Mr. Rawson.
No.
Ms. Allen.
Yes.
Mr. Bingaman.
Yes.
Madam Chair, 4 in favor of that motion, 2 are opposed.
Okay, so that motion did pass. We have a vote of 4-2. So we have renewed the contract with Shankman Capital Management for a term of 5 years. I'm sorry? Was there a question or a comment? Okay, with that, we're going to move on in our agenda to agenda item 3F. I'll pass
Thank
it
you,
over
Madam Chair.
to Mr. Lee. Yes.
Thank you, Madam Chair. Sorry, I jumped the gun there a little bit. This is David Lee, Director of Private Equity. I'm joined on the call by Portfolio Manager Chris Cassidy, also Richard Pugmire and Amy Ridge of Mercer, our consultants. And then finally, Jose Feliciano and Marcelia Freeman from Clear Lake Capital.
Jose Feliciano? The famous singer.
No autographs, please.
The materials for Clear Lake Fund 7 start on diligent page 208. And as referenced in the materials, Clear Lake Capital has a flexible investment approach utilizing different entry points in the capital structure at different points in the economic cycle. The fund strategy will focus on control-oriented value buyout and special situation investments, and will include private equity and special situation investments, structured equity investments, credit and distressed investments, and even on an opportunistic basis, public equity investments. fund will pursue investments in technology, specifically software, tech-enabled businesses and managed services, data and analytics, industrial technology, and other IT infrastructure. Industrials, specifically industrial services and distribution, packaging, specialty materials and manufacturing, building products and automotive value chain, and also on an opportunistic basis, some consumer, including food and beverage and e-commerce. The fund expects to have 18 to 22 core investments, focusing primarily on North American companies. The average check size here will be in the $500 million to $700 million range, and this is for companies with at least $1 billion in enterprise value. The target size for Fund 7 is $10 billion, but we expect it to be oversubscribed and closer to $14 billion, which includes approximately $200 million of general partner commitment. Fund 6 was roughly $7 billion commitments. Historically, Clear Lake funds have also benefited from aggressive recycling of capital, and these are from shorter duration investments, and we expect that to continue in Fund 7. Past fund performance has been excellent, as Funds 3 to 6 have been in the first quartile for the Burgess North American Buyout Universe for both net IRR and net multiple. Distributions to paid in capital, or DPI, for the last 4 funds have also mainly been first quartile. We believe that Clear Lake would be an excellent long-term partner, and as such, staff and consultants are recommending a commitment of up to $50 million in Clear Lake Fund 7, and this would be the first commitment to Clear Lake Capital Partners for us. With that, I conclude my remarks, and I will turn it over to Amy Ridge of Mercer.
Thank you, David, and good morning to everyone. So Clear Lake is a firm we've known for a long time and think really highly of. It was founded in 2006 by co-founders Jose Feliciano and Begdad Ebali, and they continue to lead the firm today. As you know, we have a really high bar when we add a new manager to your portfolio. We think, though, that this is a good addition. The things we really like about them are they have a really large and strong team. The co-founders, they remain highly involved with the portfolio and investment activity today. They have a great senior team who averages 10 years at the firm, and then they have 20-year average industry experience. The team's also been really stable. They've only had 1 senior level departure in the last 5 years. We really like the strategy. Their all-weather investment strategy. It allows them to pivot and execute whatever transactions are the most attractive at that time in the market. And typically this means more buyout weighted in times of economic strength, and then more special situations during market downturns. And lastly, as David said, their returns have been consistently excellent. They have generated first quartile IRRs, first quartile multiples for over a decade. The key areas of consideration are really around the terms. They have a GP commitment that is going to be slightly below the market, which is 2%, although not significantly lower than that, and it's still large at $200 million. And they do have a higher organizational expense amount. We have been seeing this, though, across the industry with the addition of a lot of side letters being requested from LPs. And lastly, just their fund size increase. The size is expected to double the previous fund, but we spent a lot of time getting comfortable with this, and we feel like the team is large enough to not have this cause any capacity constraints or change the strategy that they've been so successful in. So again, we are recommending up to a $50 million commitment to Clear Lake Fund 7. And with that, I will now turn it over to co-founder Jose Feliciano and Marcelia Friedman, who's a senior member of Clear Lake's IR team.
Thank you. Good morning or good afternoon. Very pleased and honored to be presenting to the council today. I'll try to be brief in my remarks, and we'll welcome any comments or questions as part of the presentation. My name is Jose Enrique Feliciano. I'm one of the founders and managing partner of the firm, As noted before, we started the firm 15 years ago. Today, Clear Lake has about $60 billion under management, most of that in the strategy that we're discussing today. We are very proud of what we have been able to build over the years. In particular, the strategy that we're presenting today. The strategy consists of essentially a sector approach where we're focusing on the sectors aforementioned: technology, industrials, consumer. We're doing that across an economic and credit cycle, and we're doing that opportunistically, meaning that the entry point of what we do could be a typical traditional buyout, or it could be something more complicated. It could be a turnaround. It could be a carve-out. It could be even something approaching or something in the special situation space. Once we do that, once we identify those opportunities, we're trying to buy the company or take control of that business at the best price possible, obviously. But most importantly, once we buy that business or take control, we're trying to make that business better. We're trying to basically implement some of the best practices that we have developed over the years. We have organized those best practices in something that we call OPS, Operations People Strategy. It's basically an operational framework about how to improve businesses. And if we do that well, what we have been able to achieve is that we are able to grow the business, make it more profitable, maybe grow faster, make it more strategic. And as part of that strategy, then when you step back, we have been able fairly consistently across an economic and credit cycle, we have been able to take advantage of opportunities in those core sectors, technology, industrials, and consumer, make those companies bigger and better, and be able to sell them, obviously, to strategics, to other private equity firms, in some cases take those companies public at a higher multiple than what we paid for them, and also taking advantage of that higher revenue, higher EBITDA, higher profit margin. That consistency is what we bring to the table. So we are able to execute everything from control buyouts all the way to special situations. And the result of that, as you see in the presentation, is that we have been able to deliver top quartile, maybe top decile return in every single fund since Fund 3. So we're very proud of that. I'm very proud of the team. The team, we wouldn't be, I think every successful firm is a mix of great strategy, hopefully, a great team and a great culture. And as noted before, we have a team that has been together, very cohesive. We hire at the mid and junior level and then basically train our investment professionals in executing transactions across that economic and credit cycle. And over time, they become sector experts. And by the time they become senior VPs, principals, and partners, they're very well versed in all things Clear Lake. And luckily, we have had a lot of consistency in that team. And I expect that to obviously remain so. And, we have implemented both incentive programs and other types of programs to ensure that retention. A couple of things that I want to maybe just highlight before I conclude my remarks. We have been able to create these returns very consistently, and we have been able to return capital a little quicker than most private equity firms. So when you look at metrics like DPI, et cetera, not only have we been able to outperform from a pure absolute performance basis, but we have also tended to return capital a little bit quicker than other strategies. That is because of what I mentioned before, that OPS strategy, that OPS know-how has allowed us to create value early in companies and in some cases sell them quickly, or in some cases extract, some type of, kind of partial exit a little bit sooner than most people. The other thing that is worth highlighting is that our returns are fairly evenly distributed, right? Our funds don't depend on one or two transactions that did really well, and the rest of the fund was more mediocre. We have a lot of consistency. When you look at Fund 5, which is our last more mature fund, we probably have 5 or 7 transactions where we're going to make 5 times our money or greater. The last thing that I want to then conclude on is ESG. In the past 3-4 years, we have done a lot of work integrating what we think are the best practices in the ESG space into our investment platform. And we have done that at first with the help of some outside consultants, the folks at Malcolm Partners. We still use them quite a bit, but now we have started to implement that and train people internally in that ESG effort and how to apply it. The first part of that effort was just measuring, kind of ESG factors or key metrics. I think we're moving to what I will call ESG 2.0 or 3.0, where we're trying to improve on that and make sure that we're not only tracking those metrics, but making sure that we are trying to link that improvement in ESG metrics to better investment performance. And I think that is really the goal that we all are striving for. Our team is very diverse, so we do when you think about ESG, we think about the E, the S, and the G, including diversity and inclusion. And again, very proud of what we have done in that metric. So in conclusion, we're very excited and honored to be considered by the council for an investment, and I would love to entertain any questions that the group may have.
Thank you, Mr. Feliciano. And we were expecting a song, but maybe we'll let you off for this time.
I'm hoping that I'm a better investor than younger, but next time.
So we're going to go to questions from the council for either the representatives from Clear Lake, Mr. Lee, or Mercer.
Madam Chair, this is John Bingaman.
Yes, Mr. Bingaman, Member Bingaman.
I'd just like to say for the record, I'm going to recuse myself from the discussion and the vote. I did co-invest with Clear Lake through our firm many years ago, and haven't done business with them in years, but we did do business together in the past, and just so I think there may be an appearance of a conflict, so I'd like to recuse myself.
All right, we appreciate that heads up. Thank you, Member Bingaman. Further questions? Do we have a motion?
Madam Chair, 3F, based on the recommendation of the Council Investment Committee, Private Equity Advisor Mercer, SIC staff, and general fiduciary oversight of RVK, I move that the State Investment Council approve a commitment of up to $50 million to Clear Lake Capital Partners 7 LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
I second that.
Very good. We've got a motion from Member Lavender, a second from Member Allen. If we could have Andy take a roll call vote on that motion.
Commissioner Garcia Richard.
Yes.
Treasurer Eichenberg.
Yes.
Mr. Lavender.
Yes.
Mr. Rossman.
Yes.
Ms. Allen.
Yes.
Mr. Bingaman is recused. So we have 5 in favor. Motion carries, Madam Chair.
All right, very good.
Madam Chair, this is Steve. If I may interrupt for just a moment.
Yes.
I'd like to address this to everyone on the phone. We're going to have a 12:30 hard stop today because certain members of the council need that. I'm going to ask you to greatly abbreviate your presentations with that in mind. Thank you.
All right, with that, we will go on to agenda item 3G, which is Lightspeed Venture Partners. We're going to hand it over to Mr. Lee and Mercer.
Thank you. This is David Lee again. I'm still here with Chris, Richard, and Amy, and we are joined from Lightspeed Venture Partners by Will Kohler, a partner, and Kathleen Foote, also a partner. The materials start on page 315 of diligence. Lightspeed Venture Partners is an established global multi-stage venture capital firm. The firm was founded in 2000 and is headquartered in Menlo Park, but other Lightspeed offices are located in China, Israel, India, the United Kingdom, and Singapore. Lightspeed seeks to invest in next-generation innovators and trends disrupting the enterprise, consumer, and healthcare sectors across the global marketplace. Lightspeed global team has 31 investment professionals and roughly 30 operations professionals in the operations and founder success team, the Lightspeed global platform, venture partners, the talent infrastructure team, and the business development customer acquisition teams. The flagship fund strategy, which is Fund 14, will focus on seed stage and early stage, which is Series A and B venture capital investments, predominantly in North American-based companies. The select funds are designed to act as an extension to the early stage investment strategy and will mainly target the top 5% of the best performing companies, and this is typically Series B or later. And the opportunity funds will target investments in the growth stage from the top 1% performing companies from Lightspeed's global portfolio, and will also opportunistically invest in new companies, typically Series C and later. The target size, Fund 14, is $1.65 billion, and will consist of roughly 70 investments. The expected check size here is $15 million to $30 million. The target size of Select 5 is $1.8 billion with a target of 30 companies, and the check sizes will be $35 million to $100 million. And the target size of Opportunity 2 is $2 billion with a target of 25 companies. The investment size will be $60 million to $125 million. Historically, Lightspeed Ventures has been one of the world's premier venture capital firms, and their funds have been very difficult to access. Performance for the last 6 funds, that's 8 through 13, have been strong, with 3 out of the 6 funds ranking in the first quartile versus the Burgess Global Venture Capital Universe. Performance for the Select series, the first 4 funds, is mainly second quartile versus the Burgess Global Venture Capital Universe, with the lowest IRR, net IRR, being 25% there. The first Opportunity Fund, which is a 2019 vintage, is also second quartile versus the Burgess Global Late Stage Venture Capital and Expansion Capital Universe. And it has a current net IRR of over 45%. Distributions to paid-in capital for all these funds have been first or second quartile of their respective subsets. We believe that Lightspeed Venture Partners would be an excellent partner for Longpool, and thus staff and consultants are recommending a total commitment of up to $60 million in spread across Lightspeed Ventures 14, Select 5, and Opportunity 2. And this would be the first commitment to Lightspeed Ventures. With that, I'll turn it over to Richard Pugmire of Mercer for further comments.
Thanks, David, and good morning to everybody. Lightspeed is a new relationship, but we think the characteristics of these funds are strong for inclusion in the national program. And Lightspeed also further deepens the roster of venture capital managers that we have. One of the challenges that we have with venture capital is deploying a meaningful amount of capital with one manager, because a lot of the good managers don't have capacity to accept a sizable commitment. And venture capital has a wide dispersion of returns, so it's an area where you do not want to compromise on finding a good manager. And Lightspeed is a high-quality manager that has a platform where we can deploy a meaningful amount of capital to that manager and still get exposure across venture capital and growth equity spectrum, everything from seed stage companies to pre-IPO companies. Lightspeed is a highly sought-after manager and is oversubscribed. And just to highlight some of the conclusions of our analysis, Lightspeed does have a long history in the venture capital industry, having started in 2000. Over the years, they've established a strong global platform with offices in multiple locations, which is unique for a venture capital firm, as not very many have the global presence that Lightspeed has. And in addition to the strong investing team, Lightspeed's also developed an operating team that assists the investment professionals across the process, everything from sourcing prospective investments, assisting with the evaluation of investments, and supporting growth initiatives. The track record is impressive, and the more mature funds have generated top quartile or above median performance. And one of the things we look for with venture capital managers is the ability to generate multiple winners from their track record and not just one winner. And Lightspeed has done that with several investments. And all of this has established a strong reputation for Lightspeed, which is important in venture capital. There's a lot of funds out there, and Lightspeed can be more selective on investments and seek out strong entrepreneurs to work with. A lot of the key areas of consideration in our report are really around the terms. We're targeting high-quality venture capital managers to add to the program. And one of the characteristics found with high-quality managers is premium fund terms. And Lightspeed's no different. The funds do have some premium terms, but they've been able to generate strong performance net of fees, which gives us comfort with the terms. Also, of the Lightspeed funds that we're looking at, the Opportunity Fund is a newer approach, having launched in 2019 to focus on later stage companies. And while there has been some early success in that first fund so far, it's still early for the strategy. Although when you look at Lightspeed's track record, they have shown the ability to really find companies that have strong long-term growth prospects. So we're recommending an up to $60 million commitment to the Lightspeed funds. And I'll turn the time over now to Will Kohler, who's one of the partners at Lightspeed, and Kathleen Fort, who's a partner on the investor relations team, for a short presentation, and then we're happy to answer any questions that you may have.
Thank you very much, and good morning. We're really grateful for the opportunity to present Lightspeed Venture Partners to you today. My name is Kathleen Forte. I am a partner of investor relations here at Lightspeed, and I'm joined by my colleague, Senior Investment Partner Will Kohler, who leads our growth practice. We will provide a short and then answer any questions that you have at the end. Lightspeed is a multi-stage venture firm, and it's 20 years in the making. The firm has grown and evolved its strategy over time. And what we would like for you to take away from our discussion today is that the firm's origin, early-stage investing, combined with our high-quality growth capabilities, gives us an unfair advantage to concentrate in the back tech-forward companies across geographies and sector verticals. We're very fortunate to have had a strong set of LPs who have supported us from the very beginning, and today we manage over $11 billion in committed capital on their behalf. We're currently fundraising our 3 core venture strategies, early to growth, which we're raising and all are under consideration today. We have a strong heritage in early stage investing, and in many cases that means being that first institutional capital into a startup, whether that's at the seed or Series A financing. But we're not only a capital partner to founders, we're also a thought partner to founders. We're very aligned with the founder's vision. We're earning meaningful ownership at the early stages. We're taking board seats, and we're really helping those seeds evolve from 1 to 2 people with an idea. We help them build out their management and technical team, their product strategy, and design the right go-to-market motion. And when the firm's founders started Lightspeed, they were known for being enterprise investors. And that foundation is still core to Lightspeed today, with 2/3 of our investments on the enterprise side and the remaining 1/3 on the consumer and the healthcare side. And we believe that enterprise is a consistent returner of larger exits, and we've seen that played out with the returns in our portfolio. We believe that the entire enterprise stack is up for grabs, and it's fueled by the rise of AI and machine learning into business mainstream, the accelerated move to the cloud, and the change of buying behavior, which is more bottoms up, more developer and end user led, which has created scale. And because of this opportunity, we've thoughtfully built out one of the deepest enterprise teams in venture. On the consumer side, recognizing that innovation is happening across sectors, we've established a consumer practice 15 years ago. Our seed investment in Snap paved the way for the transformational deals that we have in our portfolio. And Lightspeed is recognized as the top consumer investor in venture today. We are focused on consumer behaviors that have shifted coming out of COVID, and then also what's ahead, which has led to deals in commerce, a number of marketplaces, ed tech, the creator economy, including the future of workers, as well as fintech, which straddles both our enterprise and our consumer practice. And then our third sector vertical is healthcare, where we established a presence over a decade, and we believe the opportunity set has never been larger. Increasingly, biotech and life sciences are being married to our expertise in enterprise. So think of software technology, data, AI-enabled insights, all bringing rapid innovation to clinical trials, drug discovery, and diagnostics. Speaking on global, one of the core tenets of the firm is that innovation is global. Our dedication to this effort has led us to having offices around the world in Israel, India, Southeast Asia, Europe, China, as well as where I'm sitting today in Menlo Park, California. We've been dedicated to a global footprint for the last 15 years and have a good cadence for how we operate as a team. We've learned that setting up local teams is critical to building a strong presence that we have, and it's also necessary to build a relationship to ensure that we partner with exceptional founders. The early growth and growth portfolio are expected to be about 60 to 65% inside the U.S. However, we believe having that 35 to 40% of global exposure is important because innovation is happening everywhere. and we expect to see this global nature continue, especially coming out of COVID, where more talent is dispersed and go-to-market motions are global. And I'll hand it over now to Will Kohler to discuss our team.
Good afternoon, everyone, and thank you for the time. I believe you'll have the presentations in front of you, so just to orient, we're on slide 4. This is a snapshot of our team, and the mission behind the team is, as Kathleen stated, we fundamentally believe at Lightspeed, and we've constructed ourselves and operated over 20 years, that the next great company can be started by a founder anywhere in the world. And I don't think that's ever been more true than today. And what's also really critical for us is that there's a very common language and a commonality in how we work with founders in every geo. So if you look at the right side, you'll see with the gray boxes, this is our global leadership in China, Israel, India, and Europe, and also in Southeast Asia, which is really managed out of our India operation. What's really important here is if I take James, me in China, or Basil in India, they started operating at Lightspeed when we were all just one fund over 12, 15 years ago. So there's a very common way in which we approach doing early stage investing, and the ethos of really being thought partners with founders, being very ownership oriented when we engage early, and then how do we be great partners to build companies at scale. There's a lot that goes in building a concept into an initial product into a scaling company. So we have a very consistent way in which we've done that, and now that we're doing that deeply embedded in each of these countries, there's a lot of nuances in doing things at the local level. And James founded Google's initial operation in China, for instance, and Basil's been operating in India, as I said, was born and raised there, but operating there for 12 years. So this is a very consistent approach in which we deeply embed our operations in each of these international geos. We really have the same perspective when we go deep into each of the sectors that Kathleen outlined. So on the left side, you'll see we have a very strong enterprise investing focused team. We've really built out, I think, a world-class healthcare team that's very deep in therapeutics, biotech, pharma, and getting deeper in digital health. Our consumer team in the middle there has been together now for over 5 years. Jeremy Liu was our foundational partner there, and now we have Nicole, Alex, and Mercedes, who have really just done exceptional work continuing to invest in the themes that have always been very consistent for us, but also are very much adapting to the new consumer behaviors that, frankly, as a child of 3, I'm constantly trying to keep in touch with as well. And on the bottom is the growth team. And this is actually where I spend a ton of my time. It's been a real big commitment at Lightspeed from an investing strategy, which we'll get into, that we think we can generate and continue to generate best-in-class returns by concentrating capital behind our best-performing early-stage companies everywhere throughout the world, first and foremost. And then also finding those exceptional companies that even at the later stages demonstrate an ability to get a great return. And we've really built out that practice over the last 7 years. So no need to go into the particular phases, but I think you'll find it's an incredibly diverse set of people who bring challenging and different perspectives to every conversation, which we think is what drives the best decisions.
Thank you, Mr. Kohler. I think we're going to stop there and go to questions at this time. We are really trying to move through our agenda, if that's okay. We're going to go to questions from committee on the Lightspeed Venture Partners investment recommendation. Any questions? All right, let's move
Madam Chair, it's Harold. Under 3G, based on the recommendations of the Council Investment Committee, Private Equity Advisor Mercer, SIC staff, and General Fiduciary Oversight of RVK, I move that the State Investment Council approve a commitment of up to $60 million in aggregate to 4 funds of Lightspeed Venture Partners as presented in the public meeting materials, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
I second. This is Kathy.
All right, we've got a motion by Member Lavender, a second by Member Allen. Any discussion on that motion? We'll have Andy call the roll.
Commissioner Garcia-Richard.
Yes.
Treasurer Eichenberg.
Yes.
Mr. Lavender.
Yes.
Mr. Rawson.
No.
Ms. Allen.
Yes.
Mr. Bingaman.
Yes.
Madam Chair, the motion carries 5-1.
All right, we have an approval of the Lightspeed Venture Partners recommended investment, and we appreciate the folks from Lightspeed Venture being on with us today. We're going to move on to, yes, contract renewals for BlackRock and T. Rowe Price. This is agenda item 3H. I will turn it over to Ms. Bennett.
Thank you. So this is Starla Bennett, and this memo is on page 495. The SIC staff and RBK recommend a contract renewal for U.S. public equity managers T. Rowe Price and BlackRock to continue as long as the parties mutually agree. The SIC can exit the contracts at any time with a 30-day notice to the managers. Both of the strategies were reviewed thoroughly during the June 2020 U.S. structure study, and both will be reviewed again in the structure study in 2023. Both of these strategies were incepted in 2012, have performed as expected, and there haven't been any significant changes to the firm or team or any violations of the SIC's investment policy, and the manager profile follows this amendment. So that is all I have. I'm glad to take any questions.
Well, I'm going to head off the treasurer because I think he's probably going to want to add a term to this motion.
Thank you, Madam Chair. I'm ready to make a motion if I can, and I will just read this and add my 5 words to it.
Well, let's see if there's any discussion before you do that, Mr. Treasurer.
Okay.
Any questions for Starla on the renewal of these contracts? All right. With that, I will go to the treasurer for a motion.
Thank you, Madam Chair. Just to give you a break, Harold, based on and consistent with the recommendation memo set forth in the public meeting materials, I move that the State Investment Council approve the renewal of the public equity manager contracts for BlackRock and T. Rowe Price for as long as the parties mutually agree, not to exceed 5 years.
Do I have a second?
I'll second that. That's Harold.
All right, so we've got a motion from the treasurer, Member Eichenberg, and a second from Member Lavender. Any discussion on that motion?
This is late.
Yep.
I really don't like lumping things together. I think we're better to have independent motions. So I would just ask that we consider the motion as 2 motions, and we've recorded as 2, and I'm assuming everybody's vote would be the same. But I really think we should have a different vote for different entities. So I would just ask that we record it as 2 separate votes.
I'm absolutely willing to that, Member Rawson. And so maybe what I'm going to do is have you restate the motion, Mr. Treasurer, and just we'll do it for BlackRock first, please.
Okay, Madam Chair. Based on and consistent with the recommendation memo set forth in the public meeting materials, I move that the State Investment Council approve the renewal of the public equity manager contract for BlackRock for as long as the parties mutually agree not to exceed 5 years.
I'll second that.
All right. Very good. We've got a motion by Member Eichenberg, a second by Member Lavender to renew the contract for BlackRock for a term of up to 5 years. And is there any other questions on that motion before we take a vote? All right, if we could have Andy take a roll call, please.
Commissioner Garcia Richard.
Yes.
Treasurer Eichenberg.
Yes.
Mr. Lavender.
Yes.
Mr. Robson.
Yes.
Ms. Allen.
Yes.
Mr. Bingaman.
Yes.
Madam Chair, the BlackRock motion passes unanimously 6-0.
Okay, very good. Now we're going to do the same thing for the T. Rowe Price contract renewal. Do I have a motion?
Madam Chair, this is Tim. Based on and consistent with the recommendation memo set forth in the public meeting materials, I move that the State Investment Council approve the renewal of the public equity manager contract for T. Rowe Price for as long as the parties mutually agree not to exceed 5 years.
I'll second that, Harold.
Okay, we've got a motion for the renewal for T. Rowe Price from member Eichenberg, a second from member Lavender. Any discussion on that motion before we take a vote? I could have Andy take a roll call vote, please.
Commissioner Garcia Richard.
Yes.
Treasurer Eichenberg.
Yes.
Mr. Lavender.
Yes.
Mr. Rawson.
Yes.
Ms. Allen.
Yes.
Mr. Bingaman.
Yes.
Madam Chair, the T. Rowe Price contract renewal is approved unanimously 6-0.
Very good. Thank you, Andy, and thank you to the members. So next, we're going to hand it back over to Ms. Bennett to talk about the transition manager bench.
Okay, thank you very much. So this presentation is on page 498, and every 5 years, according to SIC's investment policy, RBK reviews the public equity transition management bench. Jonathan Kowalik, who's a senior consultant and principal at RBK, and his team reviewed the transition manager bench as they did in 2012 and 2017. And the bottom line is that RBK is recommending no changes to the current transition management bench of 3 managers, which is BlackRock, Citigroup, and Russell Investments. And RBK is going to spend about 3 to 4 minutes on a high-level overview and then answer questions. So I will pass it to RBK. Transition management.
Thank you.
Review.
Thank you, Starla. I was talking on mute. I apologize. As usual, Jonathan Kowalik and his team have put together a great review. I'm just going to hit some high points on that. Probably go to page 500 and just hit those high points. Again, there's an extensive, we did an extensive review. It's summarized in the memo. The presentation includes information on what a transition manager is, what they do, and why they're beneficial. Also reviews your history with the transition manager bench. You began your bench in 2012. There's been some additions and subtractions. Two got out of the business, and you added one, and you've been with the 3 that we're recommending you continue with for several years. So that history is in there. I would also like to remind the council that transition management is addressed in your investment policy statement, and we think that process and policy framework is working very well for you. The bench members have performed within the range of our expectations, and we also want to add that staff has effectively been executing the competitive bidding process that's addressed in the investment policy statement. As far as the actual review of the manager bench, we did an RFI. The shortlist criteria is included in the packet. The evaluation criteria is also included, as well as the results of that evaluation. The 3 managers transition managers that Starla mentioned have been your transition managers, and we're recommending you continue with them. BlackRock, Citigroup and Russell Investments. They scored highest on the evaluation, and they're highly rated by RBK and performed well in the evaluation process. We think they're very capable and recommend you continue as a transition manager bench. With that, we'll take any questions.
Thank you, Marcia. Questions for either RBK or Ms. Bennett on the transition manager bench review? Do we have a motion? Member Lavender?
Yes.
Would you like to make a motion, sir?
Yeah, I apologize. I got my power got whacked. 3F, based on the consistent with the recommendations memo set forth in the public meeting materials, I move that the State Investment Council approve retention of SIC's consistent existing transition managers for a 5-year term beginning in April 2022. Citigroup Global Markets, Russell Investments, and BlackRock.
Do I have a second?
I second Kathy Allen.
Very good. We've got a motion from Member Lavender, a second from Member Allen. We can have a roll call vote.
Madam Chair, this is Lee again.
Yes, I'm so sorry. Member Rawson, I should have asked for discussion. Member Rawson.
No, I just think we're lumping these guys together again. I would like to have this motion just for Citigroup Global Markets and then 2 more motions for the following ones.
For Russell and BlackRock. We can do that, sir. Member Lavender, would you be willing to restate the motion and just start with Citigroup Global Markets?
Sure. I will be happy to do that. You get to hear my voice, my dulcet tones even more. Based on and consistent with the recommendations set forth in the public meeting materials, I move State Investment Council approve retention of SIC's existing transition managers for a 5-year term beginning in April 2022 for Citigroup Global Markets.
All right, so we're going to start with that particular.
And I second that.
Very good. We've got a second from Member Allen. So we're going to have a roll call vote on the Citigroup Global Markets renewal.
Commissioner Garcia Richard.
Yes.
Treasurer Eichenberg.
Yes.
Mr. Lavender.
Yes.
Mr. Rawson.
Yes.
Ms. Allen.
Yes.
Mr. Bingaman.
Yes.
Madam Chair, the Citigroup Global Markets motion is unanimously approved 6-0.
Very good. Can we have a motion on Russell Investments?
Yes, Madam Chair. Based on and consistent with the recommendation memo set forth in the public meeting materials, I move that the State Investment Council approve retention of SIC's existing transition manager for a 5-year term beginning in April 2022, Russell Investments.
I second that, Kathy.
Very good. We've got a motion by Member Lavender, a second from Member Allen on Russell Investments. If we could have Andy call the roll.
Commissioner Garcia Richard.
Yes.
Treasurer Eichenberg.
Yes.
Mr. Lavender.
Yes.
Mr. Rawson.
Yes.
Ms. Allen.
Yes.
Mr. Bingaman.
Yes.
Madam Chair, the motion regarding Russell Investments is unanimously approved 6-0.
Very good. And finally,
Madam Chair, based on and consistent with the recommendation memo set forth in the public meeting materials, I move that the State Investment Council approve retention of SIC's existing transition manager, BlackRock, for a 5-year term beginning in April 2022.
I second that, Kathy Allen.
Very good. So we've got a motion by Member Lavender, a second by Member Allen. Could we have Andy call the roll for retention of BlackRock, please?
Commissioner Garcia Richard.
Yes.
Treasurer Eichenberg.
Yes.
Mr. Lavender.
Yes.
Mr. Rawson.
Yes.
Ms. Allen.
Yes.
Mr. Bingaman.
Yes.
Madam Chair, the motion regarding BlackRock passes unanimously 6-0.
Very good. Thank you all so much for your patience. With that, we're going to move to our last voting item on the agenda. It is 3J. We have an RFP for private credit and credit consulting. And so I'm going to turn it over to, I believe, Mr. Smith and Mr. Sable.
Thank you, Madam Chair. So in your book, page 539, I think, if you're using Diligent, is a memorandum requesting an RFP for the private credit and credit consulting area. There's some history and discussion in there in the memo. But the main point here is that the market for these types of investments, the private credit and credit area, has grown substantially in the last several years. Our investments within our portfolio have also grown substantially. And we believe the market for these types of, or this type of consulting service has also matured along with the market growth. So we think it's reasonable or prudent to go look just to make sure that we have access to the best consulting services that we can in this area. I wouldn't expect this to take more than about 16 weeks and probably shorter than that. And historically, the council, at least early on, 2010 through about 2015, put a member on these RFP committees. So I wanted to make you aware of that and offer that out also if the council wants to nominate someone today, subject to your approving the RFP, to join that committee. It would be three folks, myself, Keith Sable, and Mahal Kuznetsov will be the internal team, and we'll be assisted with at least one professional from RBK.
So, Vince, can you just clarify? It says that Axia is the incumbent consultant. So is this to go back out for bid, or is this in addition to the Axia contract?
This would be to go back out, for bid for RFPs, right?
Right. We always like to see folks have to re-up for that competition, so that's great to hear. I'm in full support of this, and we are going to have a discussion, take the vote, and then we'll go to council to see if there's a nomination for a council representative on the RFP committee. So are there any questions from the council on this particular RFP recommendation? All right, so let's go to Harold for a motion.
Okay, 3J. Based on and consistent with the recommendation memo set forth in the public meeting materials, I move that the State Investment Council approve the issuance of a request for proposals process for consulting and advisory services in credit and related strategies in the SIC non-core fixed income portfolio.
I second that, Kathy Allen.
Okay, we've got a motion by Member Lavender, a second by Member Allen. Any discussion? Hey, Vince, what has the value been of these contracts in the past for this kind of consultation?
We pay a range depending on what type of service that we're receiving from, general consulting from RBK to private equity and Mercer and so forth. I can get you a schedule of those fees.
That'd be great. Thanks. Any discussion on the motion from the committee, from the council?
Madam Chair, this is Tim.
Yeah,
Vince, would you send that to me as well? Your range of fees.
Sure, Mr. Treasurer, you bet.
Yeah, thank you.
Actually, you could probably just send it to the entire council, Mr. Smith.
We'll do that.
Any further discussion on this motion? All right, I'd like Angie to please take a roll call vote on the RFP recommendation for private credit and credit consulting.
Commissioner Garcia Richard.
Yes.
Treasurer Eichenberg.
Yes.
Mr. Lavender.
Yes.
Mr. Rawson.
Yes.
Ms. Allen.
Yes.
Mr. Bingaman.
Yes.
Madam Chair, the motion carries unanimously 6-0.
All right, very good. So with that, I could open up the council for nominations to a member from our council to sit on the RFP committee. Anyone have a nomination? No, I've got one.
Madam Chair, you might be better off asking if there was a volunteer.
I'd like to take a side bet with you that we may not get one, but I can certainly do that. Is anyone interested in sitting on this committee?
Madam Chair, if no one else is really that interested, I'll be happy to do that. I've sat on these before, and I'll be more than happy to do that for the committee, for the council.
Great. Is there any objection to Member Lavender being our council representative?
Thank you for stepping up, Harold.
Yes.
I think this is one of. I think this might be one of those deals. You know, if Mr. Lavender stands still, everybody else take a step back, and then whoever's up forward gets the job.
Well, I was open to nominating someone who's not even here. You know, that's what you get.
That's what you not here.
No problem.
So great. I appreciate that so much, Member Lavender. So Vince, Harold is going to sit on to represent the council.
That sounds great. Thanks, Harold.
All right. With that, we are on to agenda item 4, finance matters, and we're going to hand it over to our Chief Financial Officer, Mr. Schiff.
Madam Chair, I will be as brief as possible. I'm on page 541 of the diligent material. Just very few things to point out, some of them somewhat repetitive from prior months. I have, as I always do for these meetings, included a budget schedule. This one for the period, 6-month period ending December 31st, 2021. I did want to point out, although we're operating within budget, it's very likely after we complete the fee disbursements for the second quarter, and I have further basis for doing a bar. I foresee submitting a bar to get us through the end of the fiscal year, largely based upon the management fees that are driven by asset values. Given the way the market has performed over the past year or so, as well as continued very large inflows to the very large funds that we're accumulating, that bar is going to be needed. And then also for the investment holdings report, I did want to point out that this is a quarterly report that you're seeing for the period ending December 31st. You will have a roll forward balances for a month end and a quarter end. So just be aware when you're looking at that report that it depends on whether or not you're doing a month end roll forward or a quarter end roll forward when you're doing any analysis that you might have. On item number 3, agreed upon procedures, I've been working this morning, sending out sample selections selected by our auditors for the first 2 quarters of the fiscal year. They do select samples quarterly. Our deadline for submitting the agreed upon procedures reports for the first 2 quarters are March 31st. So that will be something that will be completed in the future. And then I did want to point out, and I promised this last meeting, we have included the audit report for the fiscal year ended June 31st. I believe that report starts on, if you go to page 6, let me see here, 696, I believe it is. Oh, hold on a second. Wrong number.
I read it on 615.
Yeah, I think you're right. I got the wrong number. 615. If you go in one page to 616. I just wanted to point out, for the interest of people looking at the report, if you look at the various sections that are mainly bolded, I would just suggest, if you haven't already, you can look at the report of the independent auditors, which is pages 2 through 4 of the report. The management discussion and analysis is in pages 5 through 13. And then if you kind of go down to the bottom, you can see on pages 74 through 75 of the report, that's the report on internal control. And then behind that, on pages 76 and 77, you have a summary of auditors' results and findings, which there were none. And then page 78 lists the prior year audit findings, which were none as well. And then on page 79, there's the exit conference. I did want to point out, and I think I pointed this out before, in the past we had fiduciary funds because of GASB 84. We no longer have fiduciary funds. They're all governmental funds. So just be aware of that change. And then I just wanted to, as I always try to do, if anybody has any questions on the report provided by the auditors, I think this is the 10th report that I've done since I've been CFO of the State Investment Council. I'm happy to entertain any questions that anyone might have. And that's all I have, Madam.
Great, Mr. Shipp. So questions on the CFO report? Okay, thank you for that summary. With that, we'll go on to closing matters. Agenda item 5, any old or new business before the council at this time? Okay, hearing none, we're going to go to agenda item.
I can't quite hear. What did you ask for?
I am so sorry. So agenda item 5A is to ask for any old or new business before the council. Okay. And so if folks have any kind of announcement or anything they'd like to share, to do so at this time.
Okay. Thank you. That's what I was waiting for. I am seeing a number of threat analysis coming across my computer on the potential invasion of Ukraine by Russia, and that in coordination with that, they're going to make cyber attacks on state and federal government agencies, as well as critical infrastructures. So I just say that, Steve, for your team to be on high alert the next few weeks about potential cyber attacks. And part of it is to destabilize and to, create diversions. Let's hope, A, they don't invade Ukraine, and B, the cyber attacks we're protected against as much as we can be. But every single kind of threat analysis entity has sent out notices. And I don't know if you've gotten anything, Steve, at the office, but just all state agencies are going to be targets, just like the federal government.
Kathy, we're constantly diligent and aware of potential threats. Brent is in charge of our IT department. Brent, do you have any comments?
Yes, Steve. That's a very timely comment by Member Allen. I think everybody's aware that there were some significant problems at Bernalillo County. I think also APS has had some problems recently. I wanted to emphasize, and I haven't forgotten, I still have a report or a response due to Member Allen. She made it several months ago. We have implemented some systems by RiskSense, and I reached out to our IT director yesterday. We're waiting for the latest update for this past month. They run kind of a scan of our systems and what we're doing, and I will be probably within the next 10 days or so, as soon as we get that report, forwarding out some information to the members of the council so they know what we're doing in terms of oversight as far as the system's responsibilities that we have. So it's a very timely topic, and we're very sensitive to it. And I just want to emphasize to everyone that we're taking our responsibilities quite seriously. We think that we have the right people involved in this process, and I'm happy to provide oversight feedback that we get in the future, and I'll distribute it as soon as I have it.
Great. Thank you, Brent. Appreciate that.
Wonderful. Okay, any further older news before the council? Hearing none, agenda item 5B, our next State Investment Council meeting is set for Tuesday, February 22nd. I believe it will be telephonically. And finally, we're going to go to agenda item 6 for our public comment period. So I'm going to hand it over to Mr. Woolman.
Madam Chair, we did not receive any public comment for today's meeting.
All right. With that, I will take a motion for adjournment.
This is Kathy Allen, so moved.
It's Harold, I'll second that.
All right, a motion and a second. Any opposition to an adjourning motion? Hearing none, we are adjourned. Thank you all very much.
We'll see everybody. Bye-bye.